banks are very important for the economy. But banks also operate in a very challenging environment. Geopolitical risks, digitalization of finance, climate-related risks. All these are issues that banks have to deal with. And in these times of disruption, they need to stay resilient. So what are the right strategies for banks? What are the right strategies for supervisors? Where one thing is certain, and that's the uncertainty. So welcome to join us for the ECB Forum on Banking Supervision.
Good morning, everyone, and a warm welcome to the 6th ECB Forum on Banking Supervision entitled Resilience in Times of Disruption. I'm Conny Lotze from ECB Communications, and I'm very happy to see so many of you here present in Frankfurt and also online. During this conference, we will hear from policymakers, financial executives, academics, and experts about topics that have kept us all busy over the past year. How can we address uncertainty in finance? How can we keep the system resilient in light of climate, digital, and geopolitical challenges? And more fundamentally, what is the public good of banking and supervision? So a lot to look forward to and a lot to discuss. But let's begin by giving the floor to the chair of the ECB's Supervisory Board, Claudia Buch, to officially open the conference. Claudia.
Thank you very much, Conny, and thank you very much, I must say, already at the beginning to the whole team for making this happen, bringing us all together, and thanks to all of you for coming here. It's a pleasure for me to open this ECB Forum on Banking Supervision, which we have titled Resilience in Times of Disruption. So what do we mean with disruption? It sounds pretty disruptive. Clearly, we have heightened geopolitical risks, digital innovation, which is redrawing the competitive landscape for banks. And we have a debate on competitiveness, which sometimes leads to call for loosening banking rules. And I think everybody here in the room believes and is strongly convinced that we do need global guardrails, strong global guardrails to address risks and also to avoid a race to the bottom. We need cooperation. And this is why I particularly welcome all the participants here who've traveled from longer distances to come here together and discuss. Because it's precisely the stability of the world order that many are currently questioning. So we looked at a survey that the World Economic Forum has conducted among experts, and 2/3 of them think that within the next decade, the world order will become more fragmented. And so that means public goods, such as financial stability, may suffer, and also the operational complexity for banks to operate internationally. And as I will also stress, this is also relevant for the banks that have mainly domestic national business would increase. So the whole idea of these 2 days is to discuss how banks and supervisors can navigate this complex environment. And clearly, resilience will play a key role in this discussion, where resilience for us does not just mean the resilience of the banks. Of course, this is important, but I think it's also broader resilience that we need amongst policymakers in society to adapt to the new environment. And I look forward to many ideas, suggestions, how we can best do this. So let me just use this opportunity here at the beginning to explain how European banking supervision is responding to the new challenges. And I would really like to stress 2 main points, and then the Vice Chair, Frank Elderson, will also explain a bit more what we do exactly in terms of simplification, streamlining our supervision, which is one of the areas of focus for us right now. But the main point here is that banks' management of geopolitical risk is one of our key priorities. Now, I sometimes hear it being said that, well, geopolitical risk is not really new. I mean, it was always there. And clearly also for the larger banks that operate across border, they know how challenging it can be to operate in different environments. But the interesting and important aspect of geopolitical risk at the current juncture is that actually the exposure is quite broad-based. So if we look at the banks that we supervise as the ECB, then we find that many banks, most banks, outsource critical functions, and cyber attacks are mentioned by the majority of chief risk officers. And so this means also if you have a national business only, you can also be exposed to geopolitical risk. And I think the resilience against this risk also needs to be equally broad-based, meaning operational and financial resilience, robust governance, and operational flexibility. Now, when you take these items, which are good for broad-based resilience, they're actually the same factors that also drive the long-term competitiveness and sustainable business models of banks. So I think there's no tension between resilience and competitiveness. So that's our first response, addressing geopolitical risk. The second response is to address ourselves. It's about adapting to the new environment, making sure that we operate, we deliver on our mandate as efficient, as effective, as risk-based as possible, and in the end also creating space for us and for the banks to deal with the new and the challenging environment and the evolving risk. So in the end, this is all about making supervision, keeping supervision strong, help banks to navigate the uncertain environment, because I'm strongly convinced that weakening standards in terms of regulation, in terms of supervision, would also weaken banks and would weaken their competitiveness. Let me be more specific on the issues that I just addressed. As I said, virtually all banks that we supervised are exposed to geopolitical risk. We have 40 banks, particularly the larger banks, that have affiliates outside of the EU. There's more, of course, also with affiliates inside the EU. 25% of the assets of the banks we supervise are across borders. Of that 25%, roughly 1/3, 30% is in the United States, and actually that share is relatively stable. European banks are closely connected to non-bank financial intermediaries with about 9% of their assets, 15% of their liabilities. So even though there's a smaller share of cross-border financial assets being intermediated by banks, the connections to non-banks are very strong. Many banks use cloud services that are provided by a few non-EU third-party providers, and cyber incidents, let's check whether it's on the next slide, yes, cyber incidents have clearly increased, so imposing vulnerabilities on most of the banks. So in response to this exposure of the banks to geopolitical risk, we last year put together a framework for addressing geopolitical risk, and that has two main features. One is that geopolitical risk is really a cross-cutting risk driver, and it's affecting banks through multiple channels. It's affecting their traditional risk categories. The channels are the financial markets, of course, the real economy, the safety and security of operations. So this framework we put out last year, and let's look at 1 year after, where do we stand in terms of geopolitical risk. Clearly, and I said this before, measures of global economic policy uncertainty remain elevated. And I think we've seen this very clearly around March, April, when the announcement of new tariffs led to very fast adjustments of markets, so it can change. It showed how risk sentiment can change abruptly. Credit spreads widened temporarily, but still risk premia remain relatively low, and there's an increased demand for protection against adverse shocks. We here at the ECB have done particularly work on I think it's the red line, the trade policy uncertainty indicator, to see how it's affecting banks potentially over time. So far the effects are not visible on banks' balance sheets, but the work that colleagues have done here shows that the effects build up gradually over time with regard to banks' provisioning, profitability, and also lending. And the analysis shows that, of course, better capitalized banks are better able to deal with this issue. Clearly, risks have become more difficult to model. So we've seen past shocks, the COVID crisis, the energy crisis, where loan losses have hardly increased. This is also due to the fiscal support that was forthcoming at the time. So that means traditional correlations between macro events and credit risk have become less reliable as predictors of the future. So overall, and here I think we are also in line with the IMF's recent Global Financial Stability Report, markets are underpricing geopolitical risk, and so the longer-term, medium-term effects of these heightened uncertainties we will only see in the data as time goes by. And as I've shown in the slide before, the disturbances that may occur on global markets can affect the financial system and also euro area banks. So what to do about this? Let me start with the banks, and let me also talk about the role that supervision has to play. Geopolitical risks cannot be avoided, but they need to be managed well. And they differ from traditional risk drivers in being less predictable, more difficult to model, more interdependent, which may say, well, it's difficult for the individual banks to model this and to respond. But at the same time, I think we know the channels quite well through which geopolitical risk can affect individual banks. So this can be disruptions of established trade routes, cyber attacks, energy outages. So we don't know when these events may hit, but we can describe the scenarios quite well. This is why scenario planning is so important. And this is also important for the risk management of individual banks. But clearly there can be a systematic component to geopolitical risk. And let me again use the COVID pandemic as an example. So even though one could have known that a global pandemic is a potential tail risk, I think few of us had in the cards what it would actually entail for the real economy and also potentially for the financial system. So in that sense, private ex-ante insurance was rather limited to protect against such an event, and that's why fiscal policy and also to some extent monetary policy came in ex post to provide an insurance mechanism. And just to give you some numbers, during the COVID pandemic in Europe, fiscal support to households and firms was around 4% of GDP, and in a similar range, there was fiscal support around the energy crisis. And this, of course, indirectly also protected the financial system against losses that typically one would have seen in a recession of the type that we have seen. And also during the March 2023 turmoil, there was an expansion of public safety nets. And we can all reasonably, maybe that's also something we can discuss during the breaks, we can all reasonably discuss whether similar fiscal policy support might be forthcoming if the next crisis strikes. That means banks and also authorities need to prepare. And with preparation, I mean building this broad-based resilience that I've mentioned before, strong capital and liquidity, robust governance, good operational flexibility, strong IT systems, and also diversification. And again, this is exactly the factors that also drive the competitiveness, the long-term sustainable business models of banks. And let me say that broad-based resilience does not mean predicting the exact nature of the next crisis. So this is something that also, with all the expertise that we have here in the room, I think this is something we could not accomplish, but it means protecting the services that banks provide against a range of scenarios. And for that, banks need long-term strategies, and these are actually very similar to the long-term strategies they need to respond to the changes in the environment that we are currently seeing. So there needs to be a response to the growth of non-bank financial intermediaries. Banks need good information systems. They need to respond to the increasing supply of crypto assets and stable coins. And this all needs to be considered also when considering long-term strategies to pursue. But again, let me just briefly come to the more systemic nature, of course, of geopolitical risk. This is clearly also an area where macroprudential policy comes in. And I think it's very good to see that we have now bigger macroprudential buffers in the system that can be released in case a shock hits the system. And we do not see that the capital requirements that are in place would in any way constrain banks to lend to the real economy. This is what the role of macroprudential policy is, of course, to make sure that the system is resilient. But let me also come to our role. So what is the role of supervision in supporting banks to manage risks and follow good practices? Let me say very clearly, we do not need a new regulatory framework to deal with geopolitical risk, but I think we do need the commitment from legislators not to weaken the frameworks that we have. So these frameworks require the banks to have sound risk management in place, robust internal governance, and also related to all the risks that they're facing, but also related to geopolitical risk. And these frameworks are also the basis for our work in terms of ongoing supervision. So what do we do specifically in our dialogue with the banks, how to manage geopolitical risk? The first is that banks' management bodies should have a comprehensive view of how geopolitical risk is affecting their institutions, and a comprehensive view always starts with good data. So sound risk data and aggregation, good information systems, I think this is one of the keys to inform decision making. Banks need, that's the second point, what-if scenarios related to relevant geopolitical events in order to prepare and assess different scenarios. And we are actually, with the work that we will do in terms of stress testing next year, also support the banks in developing these scenarios. So as you know, this year there was the EBA stress test focusing also on geopolitical risks. So the adverse scenario was motivated by trade tensions, market volatility. The result was that the European banking sector is quite robust against this adverse scenario. Yes, there were higher losses, as one might expect in an adverse geopolitical risk event, but also higher profits absorbing part of these losses and thereby a lower capital depletion. So this was a common scenario. Next year we will go one step further and ask banks to do a reverse stress test and look at bank-specific scenarios that could impair their financial soundness. And let me say it very clearly for those who will be directly affected from the industry here. So this reverse stress test will be much leaner in terms of the data requirements. It will build on banks' internal risk models and ICAPs. So stress testing, of course, is very important to look ahead, to do forward-looking risk assessment. And the fourth element of our dialogue with the banks is cyber resilience. So as you know, we did a cyber resilience stress test last year, and we follow up with the banks. So we generally found banks well prepared, but of course we also found areas for improvement, and we're now in a dialogue with the banks on this. Now let me briefly describe our second main response, and I'm sure we will have more time during these 2 days to discuss this, what we do in order to adapt to the new environment. And again, as I said earlier, this is to create space. So we all need to deal with evolving risks, a new geopolitical risk environment, and we need the capacity to actually do it. And so in a nutshell, what we're doing is the following. So last year, many of you may have joined these celebrations. We celebrated the 10th anniversary of the SSM. So we created a sound European supervisor, well recognized also internationally. And now we're in the process, and we've done this actually since a couple of years, to reform supervision in order to become more effective, more efficient, more risk-based. And we do this through 4 main initiatives that you see here. So one is the reform of the supervisory review and evaluation process, which we decided upon in the supervisory board last year and which is now being rolled out. It's a 2-year process, so the full reforms will be there next year. But of course, a lot of effects are visible already. Just to give an example, the SREP letters that we've sent out are shorter and also more clear in terms of what we would like to see banks remediate and achieve. And that's the second point. This is the effectiveness point. So we communicate more clearly and escalating measures. And we're as I said, strengthening the risk focus. So this is all part of this REP reform. The second big set of reforms that we started this year is under the heading of next level supervision. So maybe the 6 points are in small print, but they're very important. So they should be even bigger, because this is really about streamlining all of our procedures that we have, including on-site inspections, making them more targeted, more focused. And this is also including going through the reporting requirements, identifying overlaps, and so also reducing reporting cost. Number 3 is a supervisory culture. So of course it's one thing to decide upon all these reforms, but they also need to be lived in everyday supervision throughout the system. So this is what we achieve with the supervisory culture project. And then we have a project on measuring the effectiveness of what we're doing. So how does all of this create the space that I've mentioned? Well, under the SREP reform, we have the risk tolerance framework. So this allows the teams to go much more specifically into the specific risks, geopolitical risks, that individual banks are exposed to. Under next level supervision, we are streamlining the process for internal model approvals, which, as you know, are so far mostly driven by the requests for approvals from the industry. So there, if we streamline the process, we can be much more focused and also see whether the models are still fit for purpose in the new risk environment. I've mentioned stress testing, where we also want to become leaner and more effective. And I mentioned the reporting requirements. In the end, having good data available also makes it easier to take decisions and have less, maybe conflicting even information from different data sources. An overarching theme across all these initiatives is that we're heavily using subtech tools to streamline and make more efficient our procedures. So this, of course, supports us internally a lot to be more effective. But I think it also has a big impact on the interface we have vis-a-vis banks, so that reporting to us, interacting with us, is much more streamlined. So to conclude, let me go where I started. That basically all European banks are exposed to geopolitical risks which are heightened. I think banks do need strategic responses to these risks, just as they need strategic responses to the digitalization of financial services. In many cases, these strategic responses are very similar. So this is what I said, that broad-based resilience and competitiveness really go hand in hand. We are adapting our supervision, as I've mentioned. So supervision is about promoting good practices, identifying vulnerabilities early on, ensuring that banks address them, and also escalate supervisory measures as needed. So this is what we can do. But of course, we also need global cooperation, global coordination to really address global risk. I mean, this almost goes without saying. A stable global financial system is good for growth, it's good for competitiveness, and watering down standards would leave banks more vulnerable just when we need this broad-based resilience the most. So in that sense, I'm very happy that you're all here, that we cooperate, that we coordinate, that we discuss what needs to be done. So thanks again for coming. I'm really looking forward to 2 fruitful days of discussion, and I hope that you're also enjoying it and take something home with you. Thank you very much.
And now, we welcome the speakers to the stage for our first panel, When Uncertainty is Certain, Strategies for Banks. The panel will explore the challenges banks are facing to stay competitive and resilient. It will be moderated by Nick Comfort, finance reporter at Bloomberg. Nick has covered ECB banking supervision since its beginning in 2014, and he has proven to be one of the ECB's most inquisitive followers. Nick will introduce the panel members and welcome audience questions later in the session.
All right, well, welcome also from my side. And thank you to the ECB for having me too. An audience of bankers and people who work with bankers or supervise bankers probably knows my panel already. They're well respected in their individual fields, and you know what? There may even be a little sprinkling of begrudging admiration or even fear in the audience today. But I won't say who it applies to. So we have Sharon Donnery, a long-serving member of the ECB's Supervisory Board, with one of the most interesting portfolios for reporters like me, not just because she has communications in it. And we have Britta Schmidt on the end, a senior analyst at Autonomous Research, who I've heard grill many executives on quarterly earnings conference calls. Some of them were in the room. And last but not least, Andrea Orcel, the CEO of UniCredit, which is not only making the biggest shareholder payouts in Europe, but also buying stakes in other banks. So, since she's our host, I'd like to start with Sharon. And I think that Claudia led us in, really put the focus on geopolitics. So let's start there, please. Now, the people in the room have probably heard many speeches from the Supervisory Board on this very topic, if they follow you as religiously as I do. Your colleagues have been warning about, and yourself, about geopolitical risk for more than 2 years now. It's still in focus, and as we also heard from Claudia just now, we know that the ECB stress test next year is going to be a reverse stress test. Maybe you could tell us a little bit about what that says in terms of the evolution of your approach to it and what you're expecting from banks. Is the question of the banks having to get creative?
Okay, well, good morning, everybody. And just before I answer that question, let me just join our chair and vice chair and our whole team here at the ECB and welcome you all to our forum, whether you're here in the room with us or online. We're really delighted to see so many of you. So maybe just I emphasise 1 or 2 points that the chair made already in her opening remarks about geopolitical risk, and then we come to the reverse stress test. So of course it's not new. I mean, it's been in our supervisory priorities, I think, as you mentioned, for a couple of years now. And we will announce shortly our supervisory priorities for next year. But I think you can tell already, even from Claudia's remarks just now, that it will remain kind of high on our list and a special focus for next year too. As I said, it's also not a new risk in the sense of having to think about new requirements, and it's all about how it links with credit risk and market risk and operational risk and so on. But I suppose the way we think about how geopolitical risk feeds through into the banks is around these channels, which Claudia touched on as well. So through the real economy channel, through financial markets, and through safety and security. And that's obviously the strong link also to cyber. So very important, I think, to emphasise not a new risk and really a cross-cutting risk driver, like many of the things we see at the moment, like climate and digitisation as well. So on stress testing, and I'll come to the reverse stress test in a moment, but just to emphasise, I suppose, for us, the importance of stress testing as a supervisory tool. And you would have seen on Claudia's later slides about our reform and the simplification agenda that stress testing is also part of that in terms of course, making it simpler and maybe less data and resource demanding. But it remains a very, very important part of our toolkit. And we had the stress test this year, obviously, which already included geopolitical risk. It was very much focused on supply chain disruptions, trade tensions, and confidence effects, which I think in the end actually turned out to be really quite relevant in terms of how things have evolved this year. Now, while the stress test this year was, of course, really, really important, it is a single adverse scenario, and maybe something that it doesn't capture so well is the very specific vulnerabilities that can apply in different banks, depending on their own circumstances, their own business models, for example. And I suppose it's with this differentiation or this type of idea that we have come to the idea of a reverse stress test and why we think it's very timely at the moment and makes sense right now. I think a very important part of it is also the idea of linking this reverse stress test exercise with the bank's own ICAPs or their own internal capital adequacy assessments. So instead of giving a scenario this time, what we will do, and I mean it's still being scoped, and I see some of the team here actually because we're in some dialogue with the banks at the moment about how exactly it will work. But the idea is that we give a predefined target outcome. So for example, we might give a targeted CET1 depletion, and this then becomes the starting point for the reverse stress test. Now, as well as looking at what happens when the banks do the reverse stress test to look at this sort of target outcome, I think a really important part for us is also making sure that we look at how the banks design the process internally and how they select their scenarios, and then how this sort of fits with their ICAP. Because really a key objective for us in doing this type of stress test is to foster the bank's own risk management capabilities. So really testing not just how do they get to that number, but how does the bank actually work itself internally in terms of its own governance and risk management. And here I think the wider link to ICAP is really important. This has also been one of our priorities for quite some time, to sort of strengthen banks and their own ICAPs. So we think it will really support that. We will also, within the reverse stress test, look at some particular issues around funding and liquidity. So banks will be asked to look at some funding and liquidity metrics, which is quite important. And this will be both quantitative and qualitative. Then maybe the last thing I would say is it's very important to emphasize this is not pass-fail. So it's really not sort of set with that in mind. As I said, it's really about understanding banks' own governance and risk management, their broader ICAP. It will, of course, feed into our SREP assessment, so it could, of course, affect the banks in that way. We'll give the banks specific feedback on things that we expect to need to be addressed, and we will also plan to have some kind of overarching communication in terms of our general findings after the reverse stress test is completed.
Okay, I'm looking for the liquidity side of it too. It sounds interesting. But Britta, maybe we could move to you to kind of zoom out a bit, to have the perspective from outside of this building. You speak to international investors in big banks. Are they as freaked out about geopolitical risk as one might have the impression from these various speeches? And also, is there also maybe a differentiation between different types of banks in terms of how investors view their geopolitical risks?
Yeah, firstly, thank you very much for having me. Maybe I wouldn't be an analyst if I didn't bring some slides. You've asked me to bring some charts, so I've brought some charts. So maybe if we can take a brief look at the second slide, please. One further. If we look at just setting the scenes as to how banks are doing right now in investors' eyes, I mean, for the last 15 years, banks have underperformed the general market with a variety of risks that have emerged. And since the onset of rate rises, profitability has greatly improved, and we see that reflected in the share prices of the banks. If you look at the chart on the right-hand side, you can see that the share price performance and total shareholder return has far exceeded the rest of the general sectors, and earnings revisions have, by and large, still been positive. Even the last quarterly results season, most management teams have been quite constructive, especially on things like cost of risk, for example. If you compare that to the rest of the European sectors, how they've traded and where earnings revisions have gone, of course, it would make you quite negative. And you would think, there must be some risky areas that are ahead. But to your point, Nicholas, we do find that investors understand very much how the banks are diversified geographically. Not every bank is exposed to every trade corridor that might be at risk. We also see diversification in business models, mortgage lending, consumer lending, corporate lending. Not all of that will be impacted in the same way. If I think about what have investors asked us about the most, where they're seeing the risk, as you can see from the chart on the top right, auto exposure has been one of the areas that has been a particular focus. US consumer has also been more focused than European consumer. I think that's also a reflection of kind of the consumer lending market in Europe being not quite as deep as in the US, but there certainly the effects are felt. These exposures are also quite controllable, I would say. And the other area, one of the reflections as to why banks are in a good place right now, we've got high capital ratios, good profitability right now, which I think are the preconditions for being able to manage a challenging risk environment. But one of the things we also need to recognize is that a lot of these risks have shifted. They haven't disappeared, but they've shifted elsewhere. And this is where the discussion about non-bank financial institutions exposures usually comes up, which is, I think, a more difficult territory for investors to grab hold of.
Okay. And Andrea, I mean, so I'm sure we'll spend a whole lot of time today at the conference and tomorrow speak about the resilience of banks, but maybe you could speak a little bit to the resilience of the wider environment and what can be done by supervisors, by regulators, by politicians to make sure that the environment is also supportive in weathering geopolitical turmoil for European banks.
Well, I think, if we take it from that angle, I think we're stronger if our economic bloc is stronger, if you want to start from broader. So the more Europe is fragmented, the less you're strong as a bank. The more my capital is boxed in 13 countries and I cannot freely move it from one country to another, the more my liquidity is boxed in 13 countries and I cannot freely move it from one country to another, the more we cannot leverage the scale to become stronger, to diversify, because I need to have IT servers in every country where I am, technology in every place where I am. That's cyber risk, because I have multiple points of entry. So I think, but we all agree here, if Europe was growing in a stronger economy, if we had banking union, if we have strong capital market union, if a lot of risks that are currently on bank balance sheets were to be more broadly spread, the general strengths would increase. Now, that does not mean we're not strong at the moment, but does mean that we need to look at things in a very, very different way. So if you take us, for example, we are very European. So we have taken a view that there is still a liability we carry, but everything else, we don't want to hear it. So last year we used to hold about 7 billion of US Treasury. Today we hold 3. That's the total for the bank, Treasury. We used to have treasuries from various countries in Asia. Today we hold 0. We don't take directional bets. We don't take interest rates bets. It's all reverted to floating rates. So as we manage things that way, a lot of people ask me, well, how did you prepare for Liberation Day? First of all, nobody did, to be fair. But I think it is a lot more what if. I think you need to have a trust. You have to create a framework and have a trust that you have a culture of quick reaction, and the people who take those quick reactions, you trust that they're going to take them within certain parameters. So we're in Germany, there was it Field Marshal von Moltke who said, your battle plans go out of the window within 30 seconds of meeting the enemy, and that is correct. So if we come from an environment of 15 years where low rate and liquidity was buffering all the volatility, globalization, cooperation, respect for your peers, et cetera, et cetera, et cetera. And now we go fracture, not respect your peers, enter into war, et cetera, et cetera. I think the way we manage that, and this is a big topic in our bank, is no longer backward-looking, big plan, budget, and let's see how you organize it. It is, yes, you need a direction, but the organization needs to be ready to shift almost weekly. Mm-hmm. And it's a completely different mindset. So we need to trust that people know where we are going, what is the framework they need to act in, but can react and adjust and react and adjust. I'll give you one example. We announced our famous UniCredit Unlocked in December 2021. Stock price went up, everybody was happy. Within a month, we binned it because Russia invaded Ukraine. And the entire environment, rates, cost of risk, geopolitical risk, volatility was shifted. But we had worked so hard on understanding where we wanted to go that every component of the group quickly reassessed and adjusted what they were doing to the new reality. So I do think that that is very, very important. So if the macro around you is better, it helps. But for us, it's how do we understand what happened? How do we know that I can do all the scenarios I want? I'm 100% sure. But what will hit me is something I didn't think about. Mm-hmm. And therefore, what does the organization do when you're hit? How fast? How consistent? What is the oversight? How do you intervene? That, for us, is a little bit of a way to go to get people ready.
Okay. And Britta, I'd like to come to you again, sort of picking up on, so I'm an optimist, but I'm not sure I am optimistic enough to think that Andrea will get capital and liquidity waivers for all of his 13 markets in the next 2 years.
No.
Again, some of the people Some of the people in this room get to decide that. But one thing I am more optimistic on is CMU. I think that's something that we could have moved. Maybe you could speak to us, Britta, about the potential for banks from CMU, and also maybe also the strategic considerations that some banks may have with regards to their investment banking capabilities as a result of this actually, hopefully, one day moving forward soon.
I mean, first of all, political responses to the situation that we now have also provide opportunities, potential opportunities for banks. It is just what we're hearing right now from a lot of management teams, and I don't know whether Andrea will agree with that or not, is that it is less clear what exactly will emerge and how long it takes for political consensus to be able to drive these sort of projects forward. One of them is the Capital Markets Union, the other one is the Savings and Investment Union, but clearly Europe needs funding, and that funding needs to come from somewhere. With regards to the Capital Markets Union, I guess we again come to the topic of non-bank financial institution involvement here as well, which has got to be a little bit of more of a symbiosis, I guess, between banks and these institutions. But for banks, I think there are also opportunities in capital markets business. And I think from an analyst perspective, whenever we speak to investors about capital markets business, there's a little bit of an allergic reaction. And that is because they're typically seen as investment banking businesses that are very volatile, very risky, hard to predict, relatively high cost-income ratio businesses as well. But I think there is merit. We see more universal banks invest more in their capital markets business, not only in Europe, also globally. And I think there are opportunities to be exploited there.
Okay. And a term that's been used a couple of times today is ICAP. And if you're not a banking nerd like me, maybe some of the consumers audience watching this online, you may think it's a reference to a new product from Apple, a nice headwear. It's not. It's the internal capital adequacy, I'm forgetting an A. Assessment, thank you. But so this is something that Sharon has been addressing a couple of times here. And for the attention that has been placed on it, as critical outsider might think that that ICAP plans at banks really aren't up to scratch, and that these may be standing in the way also of banks' plans to distribute capital. How should we read the tea leaves from you and from Claudia on this topic, Sharon?
Well, first, I suppose, to emphasise the real importance of ICAP internally within the banks themselves. And of course, for us then, as part of our supervision, to look at the bank's own governance, risk management, how they use their own ICAP, and what that means for us in terms of our supervisory assessment. And I mentioned the SREP, the Supervisory Review and Evaluation process earlier on, which is our sort of annual health check, let's call it, of the banks. So it's a pretty fundamental part, I suppose, of what we look at. And now in terms of distributions, I know you probably have something to say about that as well. I suppose for us it's about this very careful balance of banks understanding the risks that are there at the moment, but also other things that they have to do. So digitization has come up a couple of times, and clearly there's a big investment needed in terms of banks' approach to digitization and to their IT systems. I suppose the other thing that's also very important for us when we think about distributions is the individual circumstances of banks. So of course we can look at the banking sector in its entirety, but individual banks obviously vary in terms of their own positions, both in terms of their ICAP and the strength or weaknesses within their own ICAP processes, but also of course their own business models and their own need to invest in IT and so on. So I think what we've seen over the last year or two, and it was mentioned already, including in the charts, is the changed interest rate environment. This obviously had a very significant effect on banks' earnings and profitability. And we have seen an increase in distributions as a result. So I suppose for us, looking into the future, what we really want to see, I think, is this careful balance, understanding their own risks and exposures, whether that's to geopolitical risk, their need for strategic investments in IT and digitization and so on, and seeing that then balanced against the need to pay distributions. Of course, I think if you go back to why we're here as supervisors, It's fundamentally to make sure that the banking system remains safe and sound. Why is that? Because it's fundamental to the economy. And we know that for banks to be able to operate, that many of them, of course, need shareholders and investors who need to get a return. So I think we absolutely accept that. It's about, I think, this careful understanding of this balance, but particularly, as I said, the importance of the long-term investment in digitisation. And Andrea mentioned, cyber resilience in particular, which, of course, requires careful attention and indeed investment.
I'd love to come to more on IT spending and distributions in a moment, but Andrea, I have to ask you a current issue as well. So you mentioned Russia early in your remarks. We had an announcement yesterday from the Kremlin and from Citigroup that they will be allowed to sell their Russian operations. Will we hear something new from UniCredit on this front as well anytime soon?
So, I think for us, Russia, firstly, we started the war. We had about 6% of our loans and local loans and deposits in Russia. We had 4.5 billion of cross-border lending to Russian corporates. If you fast forward to today, we have 0.2% of our loans in Russia, 0.2% of our deposit. I think we haven't given a new loan, obviously, since the moment of the invasion. We have about 700 million in lending, of which 400 to 500 is mortgages, which obviously I'm hostage to until they repay. The other 200 are probably going to come down and then stop there, and we're not renewing. Deposits stay, we're seen as a safe haven. In Russia, legally, we cannot not accept them, and that is an important point, but we have 900 million, we're happy about that. Contrary to public belief, or of some people public belief, Russia finances the group, not vice versa, because we have 1.5 billion of deposits of Russian corporates in Milan and in Munich that we have been sitting on since the beginning of the war and are trying desperately not to give back. We've tried to get them frozen. We didn't succeed. While we have no lines back, of the 4.5 billion of cross-border, we recovered 100%. When the invasion started, we were quoted 30 cents on the dollar. We held. They were all repaid. So if I look at what we had when we started, we had about 2.4 billion of equity in Russia, and we had all of these things. Today, we have dividend out 600 million. Of those 2.4 billion, we have recovered the 4.5 billion of cross-border. But the capital there grew because of profitability. By way of what profitability? Because we're not lending, and we are a safe haven. We take deposits from the market, and we deposit them overnight at the central bank. And we're paid 15 points, which is a great business, as you can imagine. One that the Russians don't particularly appreciate that we do, but that's how we have grown our profitability. So now what is the issue with Russia for us? The issue for Russia is, one, navigating the sanctions. I remind everybody that after, 30 years, 40 years, Cuba has 250 sanctions. Russia has 15,000. So navigate that. And they're not coinciding. EU, Canada, UK, Australia, US, they're all different. They do not intersect. So managing that is a galactic effort of compliance to go through this and make sure you don't make mistakes. So that's a big challenge. The second challenge, at least for us, not to be nationalized. So the Russians have been very attentive at not nationalizing because they think that if they nationalize, they then owe you money after the war. So they want you to make a mistake to be justified to nationalize. So we try not to make those mistakes. Why? Because if we made that mistakes, we would legally hand it on a silver platter 3.8 billion of capital that I have in there. And there is no way I'm going to do that. Not for my shareholder, but also morally, not as somebody from the West. I'm not going to do that because that money is going to go in one direction and one direction only. By the way, it's all cash because it's all excess capital. So then you have what is the worst that can happen. We say it every quarter, and Britta knows it because she follows our call. It's 80 basis points of capital. So going back on our distribution and our capital, we always have in mind that until this is resolved, 80 basis points can go overnight if we're nationalized. And therefore, they haven't. We've managed it well, but they can. Talking about, it's one of those 5% probability, 10, you can tell me 50, but I don't control it. It can happen. Obviously, if it happened, goodbye the deposits, because I'm going to try to keep my 1.5 billion on the other side, which offset more than half that amount. But this is how we're managing it day to day. We've obviously closed down retail, almost liquidated in full. So then you get to sale. What Citi has done is very different from us, meaning what they have sold is a custody business. So what is a custody business? The whole securities. Those securities are not distributing the dividend, the interest of their clients, their sanctions. So it is a pot of gold. It is cash. And they have been allowed by Putin to sell that pot of gold to Renaissance, which is a Russian organization. Of course they have. The question is, but how much did they get? I have no idea. But for the Russian, is take direct control of all the unpaid interest, all the unpaid deposit, all the unpaid dividend, all the securities that are still there, but a lot of people still hold them there, American, Europeans, and also Russians outside of Russia. So I think this does not read across on other banks. Actually, if you look, with the exception of SocGen at the very beginning, everybody tried and failed. ING tried and failed, everybody tried and failed, because when you go to the last point, the rules for sales in Russia are no one can pay you more than 40% of book value, first. And secondly, on that 40% of book value, depending on what you do, you get taxed 35% or 75%. So for me, it's a gift to the Russian. And I'm not going to give a gift to the Russian at those conditions. Is there something that will move? I don't know. At the moment, there are 4 banks that almost account for 100% of the US dollar and euro payment on SWIFT. Those are ourselves, Raiffeisen, OTP, and ING. And those banks are semi-protected because the country wants those payment lines. Although, if you look at the total volume, they continue to fall as the Russian go through South Africa, India, Turkey, China. And so I think we're in a situation where we're almost saying something will happen. Let's be prepared for something will happen. It's actually quite mechanical. They nationalize me. Worst case scenario is 80 basis points. Best case scenario, it's 35. And I try to avoid it. It used to be 150 basis points when the war started. Now it's less. But I don't think there is much more than we can do than that. And obviously, the compliance part is very significant because we have two grids, one on country and one outside of the country to make sure that we catch what could be wrong. But I think if anybody asks me, are you certain? I can't be. There are too many sanctions. I can't be. Nobody can. Yeah. But we take it very seriously, and that's where we have it.
Thanks very much for that. To be honest, I mean, geopolitical risk as a concept
is
pretty hard to touch on. So I think you've given us, I mean, nothing is tangible as a basis point of capital, at least for banking nerds like me. Maybe if we could come back to you, Sharon. So you were mentioning, and to make a connection now to cyber risk. Obviously, it's obviously part of the geopolitical aspect and another very tangible area. So you mentioned about IT spending. Are you seeing enough IT spending at the banks?
So just to emphasize, I think what you said first, I think it was a really good example of the kind of practical reality of trying to manage it. Yeah. And it also goes back to what we talked about earlier about the whole purpose, I think, of the reverse stress test, which is exactly understanding all of these specific nuances in individual banks, which can vary quite a lot. So I think it was really useful to hear that. And now back to cyber. So first of all, on IT investment, there are 2 different dimensions, I suppose. And a bit like geopolitical risk is one of these kind of cross-cutting risk drivers, I think the whole area of digitization is also similar. It's fundamentally changing the economy and the financial system. So I think banks have to think about 2 different aspects of that. So one is IT investment in their own IT infrastructure for the purposes of how their banks function in this digital world and digital economy. And the competition, I suppose, that banks have also from fintechs and other providers. So that's one aspect. And then the other aspect is, of course, cyber, as you mentioned, which has this IT dimension, but also, and I think even more so in the last number of years, these aspects around geopolitical risk. And I think, to be honest, what we see is a lot of variability in different banks in terms of the size and scale of those investments, and also what banks really need to do. So I think on the cyber aspect, we see, of course, some good practices, but we would still see, I think, banks with quite a lot of challenges around things like managing disruption or managing incidents if and when they happen. So it's really important to be attentive to that. We also see some issues around, I suppose, what you could call, planned changes and how changes are deployed and rolled out, but then things happening with that and then having to roll back and so on. So the whole area, I think, of change management and planning. So I suppose what we expect to see is not just the financial investment that banks need to make in digitization and cyber, but also, I suppose, the investment that's needed in time, planning, governance, and making sure that they are able to recover. And I think one thing, colleagues here who've heard me speak before will know I come from Ireland, and a number of years ago we had a very serious attack in Ireland on the Irish health system. It was highly disruptive, and one of the key learnings from that cyber attack was that assumptions around recovery times proved to have many weaknesses in them, and things that maybe people expected could be resolved didn't turn out to be the case. So I think this whole idea of really recovery times and planning around that is really, really important. And I think it goes back to the example Andrea gave us about really understanding your own business model, your own exposures, third-party reliance, and really going through all of that in a lot of detail, and then looking at different scenarios, which you said you're an optimist. I always say, I'm paid to be a pessimist. So in central banks and supervisors, we have to think about all the things that could go wrong. So looking at the scenarios that could happen, whether it's something you do yourself, like change management, something that happens in the wider financial system, or cyber vulnerability. It's about looking at all of those different scenarios and trying to make sure that you are resilient to them, because I think, as the examples show, we can't really predict what's going to happen. Yes. I mean, who'd have predicted there would be a pandemic? Who'd have predicted, the horrendous situation with the war in Ukraine? Who'd have predicted where we are now, maybe on trade and tariffs? So I think we don't know what the scenarios are going to be. So Claudia talked earlier about this idea of broad-based resilience. And I think whether it's financial resilience or operational resilience, we have to think in those kind of broad ways.
Okay. And staying on IT, maybe moving to you, Britta. So you at Autonomous do an interesting survey annually, I think, on tech adoption and tech at banks. What are the data points that you're picking up on, both in terms of spending on the one hand, but are there other indicators that maybe get to the governance aspect that Sharon was mentioning?
Yeah, I mean, we now find that a lot of the annual reports and public disclosures of banks have a lot of words around digitalization and cyber risk, but there are very few numbers. Mm-hmm. On that basis, we do our survey ourselves of around 50 mainly European banks. And I have brought with me a couple of results of that survey to show you. So maybe we can move to slide 3. That's it. So on the basis of our estimates and what the banks are disclosing, we do think that even excluding personnel and staff costs, they are spending around 20% of their cost base on IT, and that can be a number of different things. Of course, what we don't know precisely is what they're spending it on. And I think there's a big difference, as Sharon said. Some banks might spend it more on prevention of cyber attacks. Some might spend it more on resilience, building the resilience and the recovery. And I also find it interesting, I think there are some studies that suggest that even detecting a cyber incident can take more than 200 days and recovering from it takes more than 100 days. So there's certainly something that needs to be done. You asked about other measures as to how we look at how banks manage digitalization and also cybersecurity, and we see that the IT experience on the board has by and large increased. If you're thinking about 20% plus of the cost base being spent, then maybe having 10 or 15% of the board in IT still has room to grow a little bit further. I don't know whether it's worthwhile also touching on a couple of other points that we might touch on with regards to cyber risk. If we move to the next slide to see what are the biggest changes that we've seen, I think obviously a very big change has been cloud adoption. And we can see that even over the last 3 years, the banks in our survey, now around 70% of the banks in our survey use the cloud as their main infrastructure. And that is very important because this is going to be the host of most of the data. And I think this is also actually a really strategic point. Data, I think, is highly strategic to banks in a world where their business model is disrupted by fintech and payments, and by building a bank around data, I think, becomes ever more important. We found that almost half of the respondents in our survey have more than 50% of their data stored on the cloud. And this makes my next point really important as well, which is around identity and access management, which I think is a huge focus that also came out of our survey. And if we move to the next slide, interestingly, we asked the banks usually to rate themselves about the capabilities. How do they see their capabilities in certain areas? And identity and access management is one of these areas where the banks have actually reported a little bit less self-confidence, I would say. And I would argue that that's not necessarily a bad thing, because I think it might also be a self-reflection to see that more work needs to be done. Now here talking about, I don't know about you, but whenever I come into work, there's around 10 minutes I need to spend on having my face scanned, having my fingerprint taken, 2 different authenticator apps to be used to log into various different tools, which can be annoying, but is actually also really necessary. I mean, we've seen some SME businesses basically be deprived of their entire business because of a deepfake CEO video being shown to the CFO, and on that basis clicking a button and transferring the entire cash stash of the company. What is very clear, though, is that cyber costs are going to increase. And the chart on the right there shows you that the cyber element of the IT cost base is going to increase, and it's going to increase a lot faster. This chart shows you that the cyber cost might increase from around 3% and doubling to around 6% in a couple of years. I think what I see within some of the banks is actually that the cyber risk cost as part of the cost base is already higher than what we see on the chart there. So it's undeniable that banks are spending on this. Banks need to spend more on that. And I find it particularly interesting that the size will also make a difference, I believe. We've heard more M&A investment cases also being framed around the potential for investment into digital and IT.
Okay. And then, so we've heard a lot, so to you, Andrea, on maybe the nexus between IT spending and also distributions and capital distribution, so share dividends and buybacks. I've got to say, Sharon's comments have been pretty understanding and pretty positive, or at least in tone more so than I've heard from other ECB officials, also of late. But my interpretation, of course. But maybe you could speak to us about the delicate balance that a bank needs to strike in terms of saying, okay, this is the money I'm putting to my internal resilience, and this is the money I'm putting towards my external resilience, being attractive to shareholders, and getting that balance right, and how you come to the decision to divvy up the pot.
Firstly, I would say that it's all about balance. Okay, so if you look, okay, we're known for doing a lot of distributions, which by the way, we're the first bank who started large. We're the first bank who's paring back down. So we went up, we're down now. It costed us 20% stock reduction since we said that at the BAML conference, so on a relative basis. So we do that. I think a few things. First of all, we don't see it as a trade-off. Second of all, you have a number of priorities that you're considering when you're ending the year and you decide what you're going to distribute or not. In our case, every year in the last 3 years, we took between 1 billion and 1.5 billion of integration costs, which restated are becoming more efficient, write off old IT platform, invest in new one, create further buffers provision for risk. And we have done that. We could have maximized our net income by not doing that. But we felt that that balance was necessary because the 3 years would end and then we would have another 3 years, et cetera, et cetera. And therefore, we balanced that in a way. And this year, at the beginning of the year, we said we're not going to do any integration cost. It's a difficult year. We front-loaded, so leave us alone. In July, we saw that we were going to close the year well. We thought we were going to close the year making 9.3 billion. We will close the year at 10.5 or above. And in the third quarter, we said, we're going to do integration cost because next year is difficult. We're going to front load some technology. We're going to do. So I do think there is a balance all the time. I think when you look at technology, there are a few things to take into consideration. First of all, I think, I don't want to talk too much about the sector, but I will anyway. Mm-hmm. I think most of the leadership, board and management does not know anything about technology and AI. That's the reality. Mm-hmm. We're learning, but tell me how many CEOs come from MIT. Yeah. And that is the point. And while if you ask me, what is the VAR and what is the market risk you want to take, it will take me about 10 seconds to give you an answer. If you tell me, I need to change my architecture from this to that, and it will lead to this, this, and that. Okay, let's sit down for a few hours before I get to the answer. Mm-hmm. If you look at my time, I probably spend 6 hours per week only on digital, but with the team understanding all the projects and where they are. So I do think you need to go over the line and say, no, I'm not delegating it. This is crucial and central, and I'm going to understand it. The second thing is, where do you spend it on? Very important, and Britta is absolutely right. So we feel, for example, I can have 2 banks spending 100. One has a very obsolete technology, and it's 100% on maintaining it. And the other one has a very modern technology, and it's 50% maintaining it, 50% iterating it and developing. Which one is the better one? But to the market, they're identical. Also because of what Britta said, try to find a CEO that will say in an annual report or in a presentation, we underinvest in technology and we underinvest in IT. Nobody will ever say that. So that is the question. What do you spend it on? The other question is, how good are you at spending? So the point is, there are 2 things on that. One, JP Morgan, in my opinion, is the big gorilla out there, said that in spending in technology, they probably, I think the number was that Jamie Dimon said, they probably pour 25 billion of spend down the toilet. A European bank cannot do that. I mean, the European banking system cannot do that. So that means you need to be a lot more cautious on how you spend, where you spend. It's risk. Because, and we are too used to more is better, more is not better. More is better if you're doing more in the right places, but if you're doing more in the wrong places, it is not better. So the quality of your spend and the minimization of there will never going to be zero of the risk that you go all in places and then you realize you need to write it off in full is very, very important. And the other thing linked to that is how efficient you are. So our unit cost for producing technology is down 30 or 40%. So you could see 100. With that 100, I'm producing 40% more than I was producing 3 years ago. So all of these things, if you're from the outside and you don't dig in the detail, very, very complicated. And then there is one last thing that I think is very important at the moment. So for us, the only way is up, by the way, in technology. But if you look at what management team are looking at now, it's not technology, it's AI. Mm-hmm. Technology, in theory, most banks have the core technology, which is resilience, ability to perform the service. So what we need to operate, right? The ATM not going down, the payment not going, so that functions. There was a lot of spend on other things around automation, et cetera, et cetera. That is being replaced by a lot more on AI because the time of impact is a lot faster. And I think that change is, again, taking management team to say, ooh, what exactly am I going to do with that? But it is very important. And that change totally transforms and the way the organization does. And I'll give you one example. Take the one that the ECB would probably very much welcome, the credit risk process. Mm-hmm. We always talk a lot about that. Credit risk process. Large files. To prepare a large file on a new client, probably 6 weeks. People taking information from the net, from the balance sheet, anything you have on the company, reclassifying on the standards of the bank. Then they prepare it, they run our own models, go a preliminary decision, and then there is a credit officer who will say yes or no. And if it's over, risk committee, okay? We have a pilot, like us, a lot of banks. With AI, we had a pilot that we prepared with an agent in 2 weeks. So time to market, 2 weeks. They did in competition, but something has started 6 weeks before with that person. They prepared the entire reclassified report with a recommendation in 12 minutes. Okay? And we went to look at, it was 99% accurate. Okay? So what does that mean then? That means that if I have a risk organization of 500 people, 400 don't have a job. Because they're all the people that are preparing the files. What do you do with those in a Europe that, for example, in Italy, I can only pre-pension? But also, how do you change the mind of people who need to disrupt their organization to such an extreme? Very complicated. And then there is the other question is, if you disrupt it like this, who will ever be the senior credit officer if you didn't come through the ranks knowing the credit files because you have a little ET telling you what to do? And so I think for us, you look at it on that, you look at on transaction monitoring, anti-money laundering, all the false positive, etc. Even advice to clients. If you asked a person to have an advice on what you would invest is one thing. We have a pilot on an AI model. On your phone you can put in, and they will relate to the last 15 times an event like that happened, and in those times this happened, and then the pilot will tell you, do you want 3 strategies? And then they will come in seconds. Do you want me to execute one for you? It is, and how do you make sure that this is the right thing for the client? Now, so all of that, before you were like, I am going to be on the cloud 5 years, and I am going to migrate little by little. Now, on these things, you take a decision, you're operational 6 months later, and you need to think of all the ramifications of that and how the organization is going to judge that. So I think when we were talking about geopolitical risk, I would overlay geopolitical risk with a massive change that AI is taking in business model, in way of operating, in what is acceptable, morally and otherwise, on that. And these two things for a game of destiny are happening at the same time. And that is, I think that is the challenge on how you step back and say, how do I deal with that?
Okay. Two last questions to Britta and Sharon on AI before we move over to the Q&A section. So get ready if you have questions in a moment. So Britta, we had a lot of use cases now from Andrea. We had some also ideas of time, how things being sped up. But maybe you could set the scene for us a little bit in terms of sort of how much can be expected in terms of productivity, maybe also in savings from the adoption of AI within banks.
Yes. I think Andrea knows that I won't be able to answer all of those questions. But I think it raises an interesting point because when we look at banks talking about AI, we hear about a lot of these use cases, as you mentioned, but we haven't really heard about returns on investment. Yeah. We haven't heard about, these flashed out kind of numbers behind it. I think when we try to quantify it, one of the low-hanging fruit, for example, where we still see upside from AI in a relatively low-risk area is something like call centers. There's probably about 5% of bank staff that, could be at risk in these sort of areas. I brought another slide, if you want to see it. If you go to slide 6, On the right-hand side, we can see the use cases. When this is again from our survey, we included more questions on AI and where AI is used in production. And as Andrea mentioned, a lot of that is in fraud detection, transaction monitoring, basically fighting, AI fraud with AI, and customer service. Some of the processes that were automated already previously. We find actually that in the slightly higher risk or more consequential areas of risk management decisions, for example, or also even compliance and regulatory reporting, we were surprised that there's actually, it's a little bit experimental, let's say, the deployment of AI. And I think these are all areas where you need to have accountability in the end, and it's very difficult to transfer that to a machine. So on the one hand, that makes me think that there are still opportunities, but on the other hand, I think it also shows that banks are quite treading quite cautiously in an area where there's a risk that we're moving ahead much faster than any sort of regulatory pace can keep track of it. The chart on the left just shows you another interesting data point, I think. We asked the banks what their expected spend on AI over the next 3 years would be. And as you can see, there's quite a large spread. Most of them were bunched around 1% to 3% of their cost base being in AI, which is, I would argue, probably not that much. But some of them intend to spend more than 10% or more than their cost base on artificial intelligence. So I think it's going to be a topic that will be with us for a long time. I think we sit here as kind of analysts, banks, regulators, but I think a lot of that would also be determined by kind of politics and other regulatory entities in terms of how we're going to, make sure that there will be an ethical deployment of AI in the future.
Mm-hmm. Okay.
I think a lot is competition will drive that. I think going back on that, I would say only one thing. The difference between, in my opinion, what I feel is technology and AI. Technology, you take a decision, you modernize, you execute, and you give your bank a lower cost to serve, a more efficient system, et cetera, et cetera. In AI, it's not a question of so much execution, it's a question of adoption. So the question is, going back to what I said about the credit process before, and supposing it works for a second, big assumption. Is the team ready, not to say I will save 10,000 hours, no. Mm-hmm. Change completely the model of operation in a way that they will be 500 people less, they will use AI, they will have check and balances, and then they will take the decision or not. So we have a lot of how much it makes you more efficient. Try to get an information on anything. You now can get it immediately, but are you changing the way you do things to convert that in efficiencies? And I think at the moment the answer is no. Everybody wants the tool. Nobody wants to change the model by which we operate to convert it in efficiency. I'm talking banks. Mm-hmm.
Mm-hmm. Indeed. Okay, and then just to Sharon, to give you the last word, I don't want to cast the supervisor as the party pooper again, as so often you do get cast.
Don't worry, go on, yeah.
So, but maybe, I'm old enough to have reported about sort of the residential mortgage-backed securities. We know like PPI in the UK with payment protection insurance. There seems like, what do you expect of banks now in terms of building up the necessary governance to oversee their operations in AI in order to avoid getting into a position where they've accidentally or willfully misused customer data or missold things with this technology?
No, I think this is exactly the issue. So as has already been said, there's obviously the potential, I think, for widespread adoption and for very significant impact on the whole operating model within the banks. Our own sort of internal survey here at the ECB shows that about 85% of banks are already using AI in some form or other. And there's a World Economic Forum study also that shows about 3/4 of banking sector tasks that are undertaken within the banking sector could be suited well to either automation or augmentation. So I think it goes to what Andrea was saying, is that you could imagine a situation, I think, where there's a pretty fundamental change in the whole business model and operating model. And many use cases, Britta showed the slide there in terms of what banks could do. So from our point of view, it's about trying to make sure, I think, that banks are sort of ahead of that. So we know there are big issues around bias, for example, in algorithms. The potential for benefits to cyber, yes, but also risks as well. Model explainability. I think Britta mentioned as well, one thing we'd be really concerned about, data quality, privacy issues, reputational risks for banks. So as always, I think of course there are opportunities, but it's about banks making sure that they can kind of keep up with these developments, that they really understand the risks that are there, and they have the right governance and risk management around that. I thought Britta's slide it goes back more to the IT part, on the number of board representatives and so on that have IT experience. And that is important, that there are people on boards that have IT experience. But I think what we see now is the nature of digitization, IT, cyber, AI, means that collectively, the whole board, senior management really needs to be focused on this as a kind of big strategic issue across the whole bank and its business model. It's not just about IT investment anymore. So I think we have to really see that very broad perspective.
Okay, so I'm afraid the greedy journalist has eaten into your time for Q&A, but maybe we have 3.5 minutes, maybe 2 quick-fire questions from the room. Is anyone who would like to break the ice, raise their hand, put a question to the panel? If not, the greedy journalist can keep going. We have a lady here. Could we bring a microphone to this lady here? And maybe there's one other person who wants to have also the gentleman at the back. Like I say, quick-fire questions in order to have as long answers as possible.
Hello, my name's Kate Levick. I'm here from a think tank called E3G. I'm not sure if this is a quick-fire question, but discussion on IT risks and AI has been fascinating. I'd just like to say there are other technological changes that banks are also exposed to. I'd be interested if the panel has any comments on the potential forward impacts of energy price volatility on mortgage books. Thanks.
Okay.
And sorry
could also be one that comes up in the climate and environmental panel afterwards. But maybe and the gentleman at the back also had a question.
Yeah, perfect. Thanks. Sorry, hi, Stephen Wolf, ECB. Quick question for Andrea. In terms of the risk management in general, you talked about AI. I suppose we've seen the last 20 years how, let's say, industrialization of retail lending has led to many younger bankers knowing the process, but not pure risk. If we embrace AI even further, what will bankers look like in 25 years' time?
That's a great question. I would ask you back the question. I have a 14 years old. I used to memorize everything, and she's still very shocked when she's talking about something in math, and I say, so it's about that, and I'm more or less right. She says, how did you do that? Because she's used to ask ChatGPT or whatever for the answer, and the mind is not set up in that way. How do you change the whole educational system because we're going in that direction? I don't know, but we need to think about it because I don't think we can avoid it. This will hit us. So the question is a massive change to where we are. I think what it does is there are entire skills that are no longer relevant, roles that are no longer relevant. Now, do I necessarily need to prepare for 6 weeks hundreds, thousands of files before I become credit officer and reclassify in order to have that judgment call? Maybe in a world of, I'm just saying maybe because I don't have the answer. Maybe in a world of AI, I don't. I need to be a person with a lot of judgment. I need to be a person that is included in the team that takes the decision, that goes to risk committee, but relies on data that is homogenized in a certain way. So maybe. What I can tell you is that we've done, with our culture, we've focused aggressively on empowerment because I truly believe that if you're sitting on 80,000 people, if you don't trust them, and if they don't operate in a framework that you can trust, you're toast, regardless of your controls, because you can't control enough. But one thing, for example, consumer finance. What is the difference between what we had before? You have a plafond of 500 million in this region to go and give consumer loans. Go. Or you're fully empowered, but you have an iPad with predictive models. You're punching what your clients has, which is an in-branch person, so one of our clients, and the models give you the answer as to how much you can lend to that client, And there is centrally a weekly report of how the dynamics are going. And if we don't like it, we become more stringent or less stringent. In a way, that is a lot tighter than the plafond before. And I see the results weekly, not 3 months later. So they are positive. And by the way, does the person on the commercial side who was giving a consumer loan lose the skill set? I would argue he never had it, or she never had it, because when you're giving a consumer loan to somebody who by definition needs it, so if you need 1,000 euros to do something, it's not like you're swimming in savings. You know, so I do think that that's a net positive. So how many net positives do we have, and how do we manage with a delegation of a lot of things to machines, and how certain are we that in not 98, 99.999% of the cases, this is going to work? And what kind of people do we need to train, and where do they go? We see the new graduates. The new graduates that are coming, we just hired 9,000 new graduates. It's insane, because when they come in, these people are AI enabled. I'm not AI enabled. They are. So they come in the branch, they come in the call center. Their mind works. I need that support, and this is going to push my performance in a certain way. We give them training the old school way, and we're still figuring out how the two things can mesh. So I think it's a good question, but I think I cannot underscore enough the level of transformation in how the role of a human in an organization as complicated as a bank is evolving, and the impact of AI and of all the things that are changing what we expect from them and the roles where we put them in. So I think it's something that we need to watch, and we need to be very careful, but it is what it is. The older generation is probably a bigger problem, because they need to adjust to this, and they never will. No? So we have a corporate university. We get, at the moment, we have about 2,000 people in retraining and upskilling, et cetera, to show them what my daughter does normally at 14 years old. So I think that transition for society, very important, because if you cannot recycle with this speed of adoption, you're going to have massive problems. That's why we said lots of hours saved. Where are these people going? What are they doing? And what is the impact? With trade unions telling you, but you cannot let go of these people. And they're right. So I think it's all of that. I don't have an answer, but we are really stressing about this, because we see it faster and faster and faster, and we don't have the answer.
Okay, we're standing in the way of people's lunches, so maybe just to Britta and Sharon, is there any technology that jumps out at you that we haven't discussed today? Just to the lady point in the third row, I don't want to nail you down on energy data for mortgages, but is there something which we haven't discussed, which you think which jumps out at you as a technology that we should also be thinking about beyond the bingo card of AI and cyber?
Quantum computing on cyber.
Okay, well that's a good one. That's one for discussion over lunch. I'd love to learn about quantum computing. If there are any experts in the room, please tell me about it. But thank you to my panel. Thank you to the audience for a really fun and vibrant discussion. We're now over to the lunch break. I don't know so much about where that will be, so I pass over to the ECB staff to determine. Oh, yep. Right outside. Thanks, everyone.
We're not supposed to step out. We were told 6.
Thank you, Nick. Thank you, panelists. Very great panel to start off. But now it's time for lunch, and as Nick said, our staff will show you where it is. It's in the Großmarkthalle. And for those of you online, we will be back here and resume the conference at 2 o'clock. Thank you very much.
Welcome back, and we hope you enjoyed lunch. Coming up next is our panel, Climate and Nature on the Brink. What does it mean for banks? We welcome the speakers to the stage. This panel will discuss how we can address the risks from climate change and nature degradation. The Vice Chair of the ECB Supervisory Board, Frank Alderson, will moderate this session. Frank co-chairs the Task Force on Climate-Related Financial Risks of the Basel Committee on Banking Supervision, and as you all know, he is one of the most outspoken ECB voices on climate and nature. Frank will introduce the panel members, and there will be a Q&A session to address your questions.
All right, well, good afternoon to all of you, and welcome back in this room. I hope you had a good lunch. And you digested also what I thought was a wonderful panel, which set the bar very high. But I am here accompanied by some wonderful panelists whom I will introduce to you in a minute. So earlier today, we discussed how banks are navigating an increasingly uncertain world, marked by rapid technological advancements, geopolitical tensions, and cyber risks. Now, building on these insights, we will now turn to explore the climate and nature crises that are intensifying the risks that are faced, that the financial sector faces. And as supervisors, it is our job to ensure that financial institutions remain sound and resilient. Climate and nature risks are no longer theoretical or distant. They are here today, and they will only become more severe and multifaceted over time. From extreme weather events to irreversible climate shifts, these risks are reshaping industries, disrupting supply chains, altering asset valuations, and even questioning the very habitability of entire regions. Now, in this context, banks face a dual challenge. First, they must manage the risks posed by climate change and nature degradation, a task that is indispensable to ensure their own resilience. And second, they are key to supporting the transition to a low-carbon economy. A strategic opportunity, and I hope we will be able to talk about that word as well, a strategic opportunity that, if approached thoughtfully, can strengthen their competitiveness and long-term sustainability. Now, the extent to which banks effectively integrate climate and nature risk into their strategies, their governance, and risk management will not only shape their own future, but also that of economies and society at large. Now, today we will explore three core themes. First, the progress that banks have made in embedding climate and nature risk into banks' risk management frameworks. Two, the increasing financial costs of climate change and strategies to address those. And third, the untapped potential and business opportunities in the green transition. Now, today we are truly privileged to have with us three distinguished panelists that have much in common, but the thing that they have most in common is that they are truly intellectually honest people. These are the people that talk truth to power, and if I have a little bit of that, they talk truth to me, but they also go relentlessly where the evidence takes them. A wealth of experience that I'm sure will lead to a rich discussion. So let me briefly introduce them. Makala Markussen, Group Chief Economist and Head of Economic and Sector Research at Société Générale, who brings extensive expertise in understanding the financial sector's response to climate risks. Kevin Styro, a Senior Fellow at Resources of the Future and former Executive Vice President of the Federal Reserve Bank of New York, a leading authority on banking supervision and climate-related financial risks. And Patrick Amis, Director General of Specialized Institutions and LSIs here at the ECB, who has been at the forefront of efforts to advance the integration of climate and nature risks into banking oversight at the ECB. So together, we are going to assess where we stand, the challenges ahead, and the opportunities for banks and supervisors to act decisively in addressing these risks. So let's dive into our discussion. And to set the stage there, let's begin by assessing where we are today. So over the past years, there has been notable progress in how banks integrate climate and nature risk in their governance and risk management frameworks. And I've said this before publicly, and I will say it again today. I thank the banks for that progress that has been made over the last 5 years. I think it's notable, and I think it was necessary, but I know that so many people have worked so hard to get all the banks and then the specific banks where they worked in, from A to B, and the progress has been notable. It has been driven not only by regulatory requirements, but also by growing market expectations and the increasing visible impacts of physical and transition risks. So Patrick, I've talked too much already. I'm going to start with you. So we would like to hear what you think are the most common challenges that you see banks facing when it comes to effectively embedding climate and nature-related risks into their governance and risk management processes.
Okay, many thanks, Frank. And maybe at the risk of repeating some of your introductory words, let me start this question on challenges with progress. Because I think it's fair to say, and I think it's important that we repeat it, we have come a long way since 2019, where we started surprising a bunch of banking officials with those strange questions on climate. And we have had tremendous work. It was a steep learning curve, but I think we have now the fundamental building blocks in place in terms of risk identification, risk monitoring, risk management in the banking industry, at least in the SSM, to be sure that we can continue progressing and addressing remaining challenges. And it is very important because it shows that when we set to it, we do progress collectively. And I think this is really a message we want to repeat time and time again. There is a way, and we have been seeing a lot of progress across the board. So it doesn't mean that everything is done and achieved. We have a lot of things to do, a lot of remaining challenges. And maybe if I try to quantify or qualify them in three main blocks, I would say the first one is inconsistent and incomplete risk coverage. So we have pushed banks into a very detailed and thorough risk identification, but we still see that in a number of cases we have banks that are pretty good at looking at transition risk, but are failing still to really onboard risk identification for physical risk, for instance. We have a lot of banks that are still struggling to get data on energy performance certificates, which are particularly relevant when you start thinking of collateral valuation for real estate risks. So these are topics where we see that these inconsistencies across risk factors, across geographies, across exposures are remaining, and we will continue pushing the banks towards deepening their risk analysis. The second area of challenges from my perspective is gaps in risk quantification. And we see this in particular on ICAP assessments. We, as part of our journey towards moving the banking industry towards a sound integration of climate and environmental and nature risks into the risk management processes and the governance and risk appetite, we still see that from an ICAP perspective, this is in infancy. And we need to continue seeing progress in the way banks will incorporate climate and nature risks into their ICAP. This is the same for stress testing as well. And so, of course, one of the reasons for this is remaining data gaps. So we tend to say very often that data gaps are are more a matter of demand than a matter of supply, meaning that when we start being in need of data, we look for them and they start appearing, and over time, methodologies, data gathering crystallize, and we start getting to market standards, and this is improving. If no one is asking for it, this is not progressing. That being said, we still have, of course, data availability issues in terms of geolocalization of physical risks, for instance, and also in tagging climate and nature risks in loss events, which is a critical element for us if we want to continue progressing with respect to further incorporation of climate and nature risk into this quantification of risks. We need to have a better ability to tag the source of losses. A bank knows when there is a default on a mortgage. Whether the default on this mortgage is coming from a flood event somewhere in their portfolio is something that is still a little bit under construction, I would say. And finally, the third area of challenges for us is the still insufficient integration of climate and nature risks into the stress testing frameworks of the banks. So to be fair, we now have all SSM banks with some form of stress testing capability incorporating climate and nature. But it's far from being enough, and we will also continue pushing on this one.
Thank you very much, Patrick. Michaela, I'm going to go to you now. So from your perspective, how would you assess the progress that banks have made in identifying and embedding climate and nature-related risks into their risk management frameworks? And do you think, or do you see any areas where you think there's actually room for improvement?
So to my mind, I think what's really important to appreciate is how these risks have been evolving over time. Frank, you started by saying it's no longer something distant. It's something that we see. We see an increased frequency of extreme weather. We also see, and I think it's very important to be mindful here of, increased volatility in climate policies. Climate policies are complicated, they're difficult, and they can change with political environments. We see this even in Europe. We've seen a little bit of a pullback prior to what we saw on our own ambitions here in Europe. And I think the complexity is both on the extreme events, but also in terms of the climate policies. And I think just drawing back to our discussions this morning on the geopolitical risks, we see how environmental risks, climate policy risks, transition risks can also be embedded with the geopolitical risks. And to my mind, it's not about developing a risk management framework to manage this risk, and this risk. I think everyone in the room would be very surprised if I told you I have a dedicated process to managing the risk of monetary policy. No, it's part of a macro policy risk, and I think this is how we should think about all of the risks that we face today, especially as we see they become more intertwined. So I think a first area which is important to be mindful of is this taking an integrated view rather than thinking about things in isolation. Secondly, I think there are a number of risks where we can still enhance our understanding, because I think it's the important, and you said this as well, it's about understanding the risks. And I think there are areas, especially in the area of nature, where it's important to have a deeper understanding. You mentioned, Patrick, that a lot of the climate data is stronger. Nature data is still much more complicated. And then I think one of the biggest challenges we face, and this was mentioned as well this morning, is in how we can think about risks that have not always materialized yet. And that means that historical models may not be a good guide. If we think about geopolitical risks, these have changed dramatically in nature. Previously, they were more country-specific, more isolated. And now we're seeing something which is crossing borders, and we heard about it this morning. And that means that we have to think differently also about how we think about models. I'll say the big word, expert judgment, probably because I'm an expert myself. I like to have expert judgment. But I think there's a little bit of a need for bringing back some expert judgment here and accepting that that's something that can be part of the framework. And then I think what was also mentioned this morning, so I'm repeating a lot of what was said this morning, but in many ways I think that in terms of the risk management framework, there are lots of things that come together. I think about agility and reactivity. This is very important. Mm-hmm. But at the end of the day, the banks, we're here to serve our clients. And this has to be a key goal that we work towards. And of course, to manage the risks that those clients can put on our institutions and the risks that we face more broadly, of course, as well. So to me, it's about bringing these combination of things together. So sometimes I think granularity is good, but sometimes I think we also have to be careful not to miss the big picture. I'll give you an example. You can sit and you can look at a small geographical area and you can think maybe this is an area that's exposed to flooding risk. Maybe you've had floods happening there. But what happens if the street up the road is flooded? Do you understand that then you can no longer maybe get to the factory? Do you understand that something could happen somewhere else? So sometimes we can also get lost in the granularity. And I think we also have to try and have a big picture, holistic approach. And then once we've done all this granular stuff, is the client insured? And is there a risk that that insurance goes away? So sometimes I also think we find safety in the granularity and buying lots of data, and I love data. But I think this is something we need to focus on, building more of a big picture view.
Thanks a lot, Michaela. So Kevin, talking about expert judgment, I'm going to ask you about your expert judgment, and more specifically on what you see as the most effective regulatory and supervisory tools to ensure that banks adequately manage their climate and nature-related risks and integrate them also in their business decision-making and capital allocation.
Yep, great. Thanks, Frank, and thanks very much for the opportunity to be here. So I'm going to take a step back and start at the beginning. Why do supervisors care about the financial risks of climate change? In general, supervisors expect firms to manage all material risks, whether it's a business cycle, a geopolitical risk, a cyber event, or climate-related risk. And that's because banks play this key role in providing credit to the real economy. The challenge for supervisors is that climate-related risks might have distinctive attributes that require additional focus, additional expertise. So what are those attributes? The impacts of climate change are likely to be secular and wide-reaching. They're not cyclical and narrow. There's massive uncertainty. We talked about this topic this morning around geopolitics. So that means you need a different approach that is that builds resilience, that is more robust to a wide range of outcomes. And as was just mentioned, the past is unlikely to be a good guide for the future. So you need new data, new models, new expertise. So those are the challenges that supervisors face. So what I've observed when this works well is to be really clear about the objective of why supervisors are engaging. You'll notice I haven't used the word mandate at all. I haven't talked about the green transition at all. I've talked about ensuring effective risk management of shocks that could disrupt the banking system's ability to provide the critical financial services. I think you also need to be flexible. When there's lots of uncertainty, that means there's room for errors, that means there's room for unintended consequences, and this needs to be an iterative process as both the supervisors and the banking system learn about these risks and learn about the best ways to manage them. So that's the third thing that seems really important, is engagement between the official sector and the private sector through conferences like this one. And when Frank and I were co-chairing the Basel Committee's task force on climate-related financial risks, one of the most effective things we did was a series of outreach sessions with bankers from around the world, because the private sector faces a different set of constraints, they have different objectives, they might face different trade-offs. And bringing that perspective together
will make any supervisory approach more legitimate and more durable over time. And then finally, I think a really important point was just raised. Anything to do with managing climate-related risks needs to be embedded in the overall enterprise risk management framework. It makes no sense to think about climate over here and manage other risks over here. And that's the framing I think that was so useful in the Basel Committee's work and also this morning, the phrase risk driver. Climate is not a new risk. It is a driver of existing risks, credit risk, market risk, operational risk, et cetera. And understanding that transmission mechanism, given those distinctive attributes, is the challenge I think that we all face.
Well, thank you, Kevin, and it just reminds me of these many hours that we were co-chairing that task force together, which was a great treat. Maybe this is a good moment, according to this clock, 8 seconds too late, but still, to transfer to the next set of questions. So that's another way of saying that we are doing very good on time, actually. So as climate change accelerates, the financial implications for banks and the broader economy are becoming more severe, including the costs from physical risks like natural disasters and transition risks like stranded assets. Now, one of the critical challenges that we all have to face is that traditional risk transfer mechanisms, such as insurance, may no longer always be available to absorb these escalating costs. So this gives rise to urgent questions. So how do banks and society then actually bear these costs without undermining financial stability and economic growth? So maybe now I'll work my way back from Kevin, William, Michela to Patrick. So Kevin, how should banks prepare for the rising financial costs of climate risks manifestation, particularly in a scenario where insurance may become increasingly limited?
Yeah, so that's a very timely question. And as several panelists have already said, this is not a 2050 event. This is a today event. And we see dramatic changes in the insurance market, for example, in the United States. So I'll think about how climate-related impacts flow through to the banking system. And there are a number of factors that will determine that. So frequency and severity of shocks, the value of structures that are impacted, the efficacy of adaptation investment. Then you need to think about the bank's actual exposure. Where have they made lending investments? Where do they hold securities? There's a series of mitigants, including insurance, including government support. And then there are a number of amplifiers that can take a small shock and make it a bigger impact. So those are all the types of things a bank needs to factor in when trying to think through the impact on its own balance sheet, its own income statement. In terms of insurance, there is a large and growing academic literature looking at the impact of climate change through insurance markets and banking. And you find, the papers find exactly what you would expect. In the US, in regions where the physical risks are greater, you see insurance premiums rising, you see insurance providers pulling back, you see a greater increase in underinsurance, you see higher non-renewal rates, and all of that translates to the banking system. And again, the academic evidence shows in those regions, you see higher delinquencies, you see faster prepayments, and these are risks that banks need to manage. So if I'm thinking from a banker's perspective on the role of insurance, what do you do about that? So the first thing is you make sure you're monitoring the risks and observing what is happening in terms of the providers of insurance, the prices that they're charging, how they are capitalized, are your insurance counterparties well diversified, for example. Another thing is to work on the data that you need to assess these risks. So last year, the Federal Reserve did a pilot climate scenario analysis that looked at the impact of physical and transition risks. And one of the things that work identified was data gaps specifically related to insurance, around replacement cost values, around the types of coverage around the deductibles that their borrowers had. So ensuring that that information is timely and comprehensive is critical. And then the third piece would be to continue to work with the borrowers on how are they preparing for climate-related risks in a way that would offer greater protection. Are they making investments in adaptation? Are they thinking about their own transition risk and incorporating those into the bank's risk management approaches?
Thank you, Kevin. Very clear. Mikael, so thinking beyond insurance, is there any other alternatives that you see? Could scaling up adaptation finance play a prominent role in fostering resilience?
So I think Kevin mentioned this at the end of a long list that I agree with. But I think this is very important. The banks, as I said earlier, we're here to work with our clients. And we can help our clients as well on adaptation. This is unfortunately something that we're going to have to do much more of, given the direction we're heading in at the moment. And I think we have an important role to play here. But I also think it's very important that policy is there as well. Because I think between the supervisors and the banks, there are things we can do. But if you don't have public policy, think about Tokyo, okay? So I grew up partly in Tokyo. Nobody is that worried about all of the houses falling down where there's an earthquake, because there are strong building standards. So there has been adaptation to earthquakes. So I take this as an example. We see horrific things happening when there are earthquakes in areas where the adaptation has not been done. And so I think adaptation, it doesn't fix everything, absolutely not, but it can be key. And I think having policy in place to support the adaptation is incredibly important, because adaptation, it's a cost avoidance investment, as opposed to the type of investment where you're hoping to make a huge profit from the investment itself. So it's a different investment in terms of its structure. Cost avoidance can be extremely important, and it can be a question of survival for companies. But I do want to emphasize that policy dimension.
Thank you very much. Very clear. And we Dutch know a little bit about adaptation. We've been building dikes in the Middle Ages, etc. There comes a time that maybe the sea gets too high. So Patrick, it's time to transition to something I know is very close to your heart, which is transition plans. As banks are growing, are facing growing physical and transition risks, how can they actually develop robust transition plans that do not only reduce their exposures, but also account for the evolving limitations of what we talked about earlier, traditional insurance?
No, many thanks, Frank. And I think I fully agree with what was said before. And in particular, it's very clear that we supervisors and the banks are not the only game in town, basically. That's for sure. I think from time to time, we would like also to remind ourselves that not being the only game in town doesn't mean that we should not be playing. And we should not also over-rely on public finance, for instance. And this question of adaptation finance, to me, is a critical element also of transition planning, of sound markers of transition planning for the banking industry. Maybe let me start with a few points on transition planning. First, when we take the EBA guidelines, and we need to start from this perspective, we see that the vast majority of what is in the EBA guidelines was de facto already covered very largely by the ECB expectations published in 2020. And for very simple reasons, because the EBA guidelines on transition planning are being built upon the traditional markers of sound risk management. And here I fully agree with Kevin. We are supervisors. We care about risks. And this is what we really pushed for in the last 5 years. So it means the good news is that a big part of these EBA guidelines is already well in train and well known by us and by the bank. So that should make things very easy. We have a number of novelties around portfolio alignment, around profitability in particular, around expectations with respect to customer engagements. That are the novelties a little bit we need to think about. And we are going to do this recognizing that it is complex, and we are going to do this taking a little bit our time to better understand the challenges that are out there in the banking industry, do this in dialogue with the banking industry, and meaning that we are not going to start enforcing whatever on the 1st of January 2026. I think there is an excellent piece of blog from a colleague right next to me that was published mid-July on our website that explains very precisely how we intend to go about it, that I would recommend reading in that context. So we will be taking our time, discuss with the industry, with the banks, try to gather information, and then move on. But we will do this in very strong dialogue. One important topic, we will concentrate on climate and nature risks. The regulation and the guidelines speak of ESG. And we actually believe that if we want to do a very good job, a sound job on the different markers of or components of ESG, that is actually very different methodologies, conceptual backgrounds, and so on and so forth. And so we will concentrate on climate and nature. And if you allow me a bit of a joke, these days when we see ESG, we tend to read environment, security, and geopolitical risks. So that's something that we will continue looking at, focusing again on climate and nature. Another important element, it is not our mandate to tell banks to which sector or company they have to lend. We're not going to do this. It is our mandate to make sure that banks do have a sound understanding of the risks they take when they lend to a sector, a particular sector, or a particular company, and that they do incorporate that in all the different components of the risk management framework, risk appetite framework, including profitability and capitalization via their ICAP systems. But we will not be the ones telling them where to lend. And that's, I think, a very important topic. A few key markers we can already identify, and we are not going to go further than that right now because, again, we want to discuss with the banks. But a long-term perspective is critical. We are not going to look at the picture on any given day. We are more interested in the cinematic. And so we will be looking at these particular features of transition planning. Transition is a cinematic movement, and we want to see how banks look at this. It does not mean that we will be particularly interested in a point-in-time picture. Customer engagement will be super important. And all the more if we see that it's sometimes it might become a little bit more difficult to get customer information from regular reporting. It will depend, of course, on the outcome of a few legislative developments, but customer engagement will become even more important in that context. And finally, to the point of Michaela, adaptation finance. How do banks look into adaptation finance? Because this is not only a risk management question, this is also a future profitability question, and this is also an opportunity for the banks.
Well, thank you very much. So to just manage expectations a little bit, we are now entering our third block. We have 11 minutes and 11 seconds for that, and then it's time for the audience. So if you're getting slightly bored at one point, start thinking about the questions you want to ask. But I think actually that's impossible to get bored because you just made some statements that if I were the wires, I would pick them up, Patrick. So that was all very good. Now, if you have some word cloud over you now hanging, there's lots of big risk words there. And I think it's time to start adding to that word cloud opportunity. And you already mentioned it, and some of you at one point did as well. Because the green transition does not just present challenges. It is also significant business opportunities for the financial sector. With annual investment needs estimated to range from 738 billion to 1.2 trillion to meet EU climate goals alone. So banks are at the forefront of the financing of this transition, and we are already witnessing encouraging developments, such as green bonds generating more fees for banks than fossil fuel deals. I'm not going to repeat that, but that little pause, I just thought it was nice to say. It's just fact. Making a key turning point for the financial sector. But there are many other examples. Patrick, we are increasingly seeing how some banks are actually positioning themselves as leaders in the green transition by adopting strategic, long-term approaches to financing sustainable development. Now, from your perspective, what specific practices or innovations set these banks apart? And how can supervisors and maybe slightly less advanced banks accelerate efforts to unlock new growth opportunities?
Okay, yeah, and I will be faster, I promise, on the third answer. Very quickly, what we have been seeing across the board when we scan the bank's practices, if I try to categorize, one thing we see as a distinct feature is leveraging on the strategic value of stress testing and embedding the outcome of stress testing into strategic discussion and influencing, informing capital and portfolio allocation at the end of the day. Very clearly, we see a number of banks that are already reasonably advanced in that direction. And we think this is a very good practice. The second element we see is commitments to improving data availability and data quality. So we see also a number of banks really going into a very detailed structure of internal quality assurance on data. So being able to use deep proxies, let's put it like that, where they are missing something more refined, and moving the data quality or the quality assurance ladder as they progress, and having very structured frameworks around this, and experimenting with data sources and crystallizing their methodologies as they move, and making use of this for probably superior decision making. The third element is working further towards comprehensive quantification. And this one, of course, is a very difficult topic for not last for one of the reasons mentioned by Kevin, which is the fact that these risks are not cyclical. They tend to be, of course, a little bit exponential. And that means that quantification is only, and data gathering and loss history is only the first step. You need to see to anchor and ground your methodologies, but then you need to progress further in terms of quantification. And we see a number of banks that are already doing this. And perhaps the last point is nature risks and progressing on nature risk identification. This is a little bit the new frontier we have. We're not going to do anything specific on nature, so we are onboarding nature into our climate and environmental risks framework. And I fully agree also with Michaela that at the end of the day, we are not inventing a specific framework for yet another category of risks. And I was super happy recently, we were talking to a bank with respect to geopolitical risk, where the CRO in front of me said, well, it's very simple, we are reusing the framework we developed for climate for geopolitical. And this is exactly the type of synergies that we want to see. And I stop here.
Thank you, Patrick. Mika, banks often express their support and their willingness to help with the transition. But then what we hear is that many times they cite a lack of viable projects with an appropriate risk-return profile. So how can banks then actually strike the balance between short-term profitability pressures and the long-term investments that are needed to drive a sustainable transition?
So I think if we look at the European banks, many of us are over 100 years old. So if we were just focusing on very short-term profitability, we wouldn't be able to boast of being so old. And I think at the end of the day, I think the banks are really not thinking about a trade-off between short and long term, because we would like to be here for another 100 years at least. And so to my mind, profitability and viability go hand in hand. I don't see them as being opposing forces. And if we think about what makes a good investment, it's something with a good credit risk from a risk perspective, and something that helps our client build towards what they want to achieve. And that's really the business we're in here. So let's think about what's happening in Europe today. And I think the Draghi report gives us some really nice ideas about how we can combine opportunities. Because if we look at the EIB, they do a very nice survey of European companies. They also ask US companies. And when we look at the European companies, what are some of their concerns today? High energy costs, uncertainty. Those are actually the two where European companies have a much higher score of this being an issue than US companies. There are others as well, but those are the two biggest in terms of differences. And when we listen to what the Draghi report tells us, it tells us that in Europe, energy security is a key topic, energy costs is a key topic, and in our case, as we're net fossil fuel importers, that has to come from decarbonization. So this is identified not from a climate perspective, but from an energy security, energy cost, a real business question here and today. And so when we look at the Draghi report, I think if we were to implement the competitiveness compass fully, so I'm back to the policymakers again, but I think it's absolutely critical, well then we can see that this would drive a lot more investments to take us towards a decarbonization strategy. So I think it has to be about policy also working together. Just as it's not up to the supervisors to go out and tell the banks which sectors to lend to, it's also not up to the banks to go out and dictate to corporates what they should be doing. We all have our jobs to do. Our job is to manage risks and work with our clients to make sure that they can also manage these risks from their perspective. The policymakers have to give us a good policy framework, and you have to make sure we have a good, stable financial environment. Now, when all three work together in a good way, I think that's really the most important thing. So, to my mind, we need to listen to what the companies in Europe tell us, what their issues are. And we have Mr. Draghi, who has done a fantastic report. And now, all we have to do is make sure that happens. So, I think there's a lot of opportunity. And I will just say, we often criticize in Europe, we're very critical, but I think right now we see quite a positive momentum in Europe. There's still a lot of work to do on delivering. And then a final point I want to make, because I cannot go to a panel without mentioning the Savings and Investment Union, or call it Capital Markets Union, whichever name you prefer. Because at the end of the day, what do banks do? Banks lend money. We deliver credit. We do not deliver capital. And if we really want to have the technologies that we need, and this is true for adaptation, it's true for energy, it's true for many, many topics, we need to have much more risk-willing capital in Europe. So I think developing the Capital Markets Union, and again, Mr. Draghi put it in his report, you'll think I'm a big fan, I am. So it's very important that we have all of these engines working together.
Well, thank you very much. And, you know, there is always, you know, singing the praises of a former president of this house in this very house is great. And actually those who have, you know, followed up in his footsteps in the board, we have been very, very vocal that we could not agree more with what you just said. Capital Markets Union, Savings and Investment Union, completing the banking union, taking away the barriers to the internal markets. There are so many things that are just really in our hands. There's many things that we talk about today that we cannot influence directly, but this is something that we have in our own hands, and it has huge opportunities for growing competitiveness in Europe. Kevin, as banks are then actually increasingly pursuing opportunities in the green transition, how can then supervisors ensure that robust risk management practices are maintained and climate and nature risks are adequately priced to safeguard that longer term financial soundness?
So I think we are all in violent agreement on many of the questions that you've asked, so I'll just make 2 quick points in the interest of time. So one, over the last few years, I've seen a shift in language, which I think is very constructive, away from promoting green finance to financing our clients' transition. That is the job of what banks need to do. And they need to do that in a well-controlled, risk-managed way, but that's their role. And then the second point, which we haven't really talked about, but I think is important from a supervisory perspective, is all of these, the risk management steps, the opportunities, is likely to be very heterogeneous and impact different banks in different ways, given their business model, given the risk appetite that their boards of directors set, given their geographic location and the perils that they face. So I think it is important to ensure that any supervisory perspective has to account for those idiosyncrasies. This is not a very simple problem. It's a really complex problem that requires a deep understanding of the firms themselves.
Thank you so much. But this is not my closing remarks, because now we're going to open up to the audience, both here in the room and also, if I understand how this thing works, virtually. So I'm looking around, and I see a hand right there. So, and you start, please.
Hi, thank you very much to the panel for a great discussion so far. My name is Kate Levick. I work for E3G, and I'm also the founding director of something called the International Transition Plan Network. So I was very pleased to hear the section all around transition plans. But I did have a question about that in relation to some of the remarks made on the panel. Akali, you talked about the role of policymakers and spoke warmly about the competitiveness compass. But one of the ways that's been implemented is to unleash a widespread simplification agenda that's led to an EU vote today in Parliament that looks like it will sweep away a policymaker's tool that would have actually set a direction of climate transition for companies in setting requirements for transition plans. And there's also been substantial pressure from other major economies around some of those requirements and pressure on the EU policymakers to roll those back. So I guess my question is, the ECB and other European supervisors, they aren't the only players on the field, as Frank said, for sure. But what does it mean for the ECB and other supervisors if other players leave the field? And where is the cross-authority cooperation that we need on this? Thanks.
Thank you. Very topical question. Patrick, you want to have a first go?
Yeah. I think, what does it mean? First, I don't think everyone is leaving the field. We have a huge number of participants in the NGFS to start with. And so there is still work ongoing. And my sense is that we may have less talks around it, but it doesn't mean that the work is not progressing still. And so we will see, of course, how this develops over time, but my sense is that we still have quite some discussions, progress on the supervisory side, not only in banking and insurance as well. It's extremely vivid because of the insurance gap and so on. And We are developing more and more discussions among ourselves as cross-sectoral to better understand how we go about it. And so I don't think we have a complete setback of everything. This is a little bit less vocal for a number of reasons that we all understand, but this is still happening.
Michele, do you want to pitch in from the perspective of a bank, saying, okay, you know, if we have very ambitious disclosure rules in a certain jurisdiction, could be here in Europe, could be anywhere in the world. These are, of course, then data that are freely available, if you like, for me as a bank, which could be seen as a, something that could help your risk management. So if there's less of that, how would you deal with that?
So when banks engage with their clients, we're used to engaging in terms of their risks and trying to understand them. We don't always have exact data points on all of these risks. We talked this morning about geopolitical risks, which could be a risk faced by a client as well. So this is something that banks are used to working with their clients on. Now, of course, the more data that there can be available, the easier that job can become. This is true. But I think what the bigger question here is, how do we deal, and it loops exactly back to what we discussed this morning, how do we deal with an environment where policy is more volatile, more fragmented, and more uncertain? And if we think about a business environment, talked about good investments, it's exactly the opposite that we need to foster economic growth. So the reality is that the banks will have to operate in this more volatile, this more complex, this more fragmented world, and continue to do, and I think Kevin said it very well, continue to do the job that we're here to do, which is also to help our clients manage these risks, because our clients face exactly these same risks, more volatile policies, things that move back, things that move forward, things that shift around, things that become more fragmented, extraterritoriality. All of these risks are risks that our clients face, and our job is to do our best to try and help them in this environment. So I think this is really, but I think this policy volatility and fragmentation, uncertainty, it's really one of the areas that's shifting in a big way, and it's not just about climate policy. We see it across the board in many areas.
You want to pitch in, Kevin?
I'll just add to that. I think the point about policy volatility is really important in two different dimensions. One over time, policies going up and down, and one cross-sectionally, policy differences across jurisdictions. And firms, both in the financial and the non-financial sectors, need to manage those changes every day. And when we would talk to the industry, one of the most common bits of feedback was the need for certainty and harmonization. And firms will adapt to anything, but it's easier if you know what it is.
Thank you. Any other questions? I'm sure there are. Don't be shy. If this was a classroom, I will just assign someone, but that's probably not how it's being done in a conference. No other questions? Any questions amongst the three of you that you heard something that you said there was quite a high level of consensus here, but maybe there was something that you would want to maybe address?
Well, I'll ask a question in that case, because Patrick, you mentioned the NGFS, and I think the NGFS has done a lot of work. We talk about things like scenarios. One of my big dreams is, when are we going to get some more scenarios on nature?
This is
so sorry to put you on the spot.
No, I think this is a very good question, and there is work ongoing actually on that topic within the NGFS. The good thing of the NGFS as well, and it doesn't mean that everything is stopping in Basel. We will probably continue having some work being done in Basel as well. But the very good thing in the NGFS environment, it's supervisors, but also central banks. And so we have a cross-sectional view from very different perspectives, micro, macro, monetary policy, and so on, that is super helpful in advancing rather novel questions like nature, and this is in particular the point for stress testing. So stay tuned.
So you're not going to give me a date?
I hope I'm not going to give you a date, but there is still work ongoing for sure.
Maybe building on this, I would have a question maybe also to you, Michaela. I'll just play ping pong here a little bit. As you know, it's making scenarios for climate is difficult. Making scenarios for nature is maybe even more difficult. Making scenarios that actually integrate these two are maybe even more difficult. But one thing that we all struggle with is these tipping points in these scenarios. And we now know that whereas maybe, some years ago we would hope that we would, end up with, safely on a 1.5 degree scenario, that, if we now read the latest science, that is just not going to happen. The world is now on a pathway close to 3 degrees, I think now, worldwide, maybe Europe more. So the risk of tipping points occurring, and them occurring actually much earlier than we thought. And also the tipping point triggering the next one, so kind of like a domino, so the compounding effect. Is that something that you are modeling already in your bank? Are you thinking about this? Are you in the wide range of scenarios that you're trying to think about? Is this part of the thinking already?
So we have tried to look at tipping points, but it's incredibly complicated. And I think the big question mark when you're working within a bank and you're looking at risks, again, coming back to what we're trying to do is we're trying to understand the risks that our clients will face. And if we're trying to understand the risks that our clients will face, there are, of course, a multitude of potential futures, and again, with many topics involved. The issue is also, if you identify a scenario in which something happens and it's uncertain, what actions can you then take from it? And that means that multi-scenario approaches are very useful because it gives you an understanding of trying to map out and see, is there something I'm missing, that the risks that this client faces that could then come onto the bank and impact us. Once you start doing scenarios about tipping points and these kind of things, it becomes very binary, it becomes very difficult to manage in terms of what concrete action you should derive from it. And Patrick, you mentioned what I think was a very important point about stress testing and about using this to inform strategy and the broader view of the group. What do you do with tipping points? It's very, very hard. It's very, very hard. That's not to say we should ignore them, but they're very difficult. And the NGFS scenarios recognize the challenges of building this into the scenarios, so it becomes incredibly hard. What's interesting is that when we talk about climate, we talk about very big systemic tipping points very often. When we talk about nature, we're talking about much more localized tipping points. And so here we get additional complexities. That's why I'm so much looking forward to the scenarios. We get these additional complexities that play in. So I think it's very, very hard. So yes, we've looked at it, but it's very hard to build in. There's some excellent work that's done on all of this, but very hard to build into models.
Thank you. Kevin.
Yeah, maybe two distinct points. One on tipping points. I think it's important to realize that there are two different types. One are the fundamental climate tipping points that might make the shocks more severe and amplified. And the second are the economic tipping points that would be common, say, in the financial stability literature, the amplifiers. It's not just whether my house gets destroyed in a hurricane, it's whether the infrastructure gets destroyed, the bridge, what happens when there's migration or relocation of economic activity. And these are much harder to model. And I think that's where the microprudential supervisors can really team up with the macroprudential work to better understand that. The second point on scenario analysis, which was mentioned, it is just so critical to be clear on what your objective is. If your objective is to find a number, what is the dollar value loss in a scenario, then you're tied to a specific scenario. if your goal is to understand what is the heuristic, what is the risk management approach a bank is using to consider scenarios and uncertainty generally, then it matters a lot less whether you get the scenario right. It's how do you process this scenario and incorporate it into the resilience that you're building.
Very clear. I see a question. I knew it was going to happen.
Hi, I'm Elio. I'm from Fleischmann Hillard EU, and my question is, how can we support EU banks in getting them to kind of get better environmental data, when at the same time we're asking a lot less of our EU corporates in terms of not just the thresholds of when they should be reporting, but in the actual granularity of data that they report. Thank you.
You're back to the data question here. Some insight still on this?
Maybe if I
Please.
can make a point. So I'm not saying data is not important, but if I had a wish list for Christmas, I'd much rather ask the question, how can we make sure that we deliver on all of the potential of our single market, we deliver on the roadmap set out in the Draghi report. I think we will achieve so much more if we focus on this and move ahead in this direction. So if I have a wish list for Christmas, I'm going to wish for the Draghi report rather than I'm going to wish for more data.
Well, thank you very much. That gives me 5 seconds now to wrap up. I want to thank all three of you. You did what I hoped you would do, and that is be intellectually honest, speak your minds on something that is clearly very relevant. I liked a lot that I think all of you reminded us what banks are for. Banks are there to finance the economy, to make sure that firms can thrive, can be competitive, can gain the wealth that we all need as a society to work with. Therefore, they need to manage their risks. We are there as supervisors to play our role to make sure that banks do that well. Part of these risks are driven by different drivers, and climate and nature crises are a driver. There are others, but they're also there and they are material. So it's important that banks do that well. And my true hope is, and that is a little bit the hope that, many decades from now we look back to the decade where we actually, with the NGFS, with our expectations, with the TFCR, with all our the conversations that we have had, that we were able, as a system, not just as a supervisor, but as a supervisor together with the banks, as a system to become more resilient, so that banks could actually withstand these risks, take the opportunity to come with it, thrive, and be just as successful in the next century, as you said, as they have been in the century past. Thank you so much.
Thank you.
Coming up next, our panel, Private and Public Value, the two faces of banking. Let's welcome the panelists to the stage. This panel will explore the public value of banking and supervision and whether there is a trade-off between shareholder value and wider public interest. The panel will be moderated by Naomi Lloyd, a TV journalist and former presenter for Euronews and the BBC. She has interviewed heads of state, finance ministers, and EU commissioners. Naomi will introduce the panel members, and there will be a Q&A session to address your questions.
Well, welcome to our next panel conversation. I love that voice of God intro as well, by the way. I think that's a great addition. So welcome. So our conversation now, as you just heard, is about private and public value, the two faces of banking. And joining me to unpack this are our two distinguished panelists. We have Jelle Benner-Heinecke, who's Vice President of Better Finance, Richard Nodder, who's Vice Chairman at Goldman Sachs. Welcome to you. We're delighted to have you here. Just before we dive in, we do want to hear your comments, your questions. So if you're watching online, feel free to throw those in as you go along. I'll take them at the end. And if you have a burning question or comment here, hold on to it. We'll do our best to give you some time at the end. So, okay, well, let's get started. Jelle, so just to know a little bit more about both of you, you are the Vice President of Better Finance, which is an organization which advocates for fairer, more sustainable, and more transparent financial markets for individual investors. And you are also, let me get this right, formerly Deputy Chief Executive, now Senior Advisor of Germany's oldest and largest association for private investors, DSW. Richard, there's a long list, I'm going to keep it quite short, but essentially you are Vice Chairman of Goldman Sachs. You previously served as the head of Goldman Sachs International for nearly 20 years. There's a lot longer list as well. And you've been with Goldman Sachs in various high-level positions in different continents for nearly 4 decades. Wow, we have a huge wealth of experience and knowledge between you. I'm looking forward to picking your brains on this. And so we get the perhaps more philosophical conversation in our panel discussion, which is quite nice, quite unusual perhaps. And I wondered if we could start by defining what we mean when we're talking about public value and public good. So we're all agreed on what we're talking about here. Okay, so I'm going to go first, and then I'm going to ask you. So the term, I have learned, was originally coined by Harvard professor Mark H. Moore, who saw it as the equivalent of shareholder value in public management. He sees public value as the value that an organization or activity contributes to society and the common good. Nearly done. And he also describes it as a concept that directs your attention to conditions in the world that you'd be interested in improving other than your own material well-being. This is what he says. I wonder what you make of that. And I'd like to know, in your view, what do you see as the public value in banking and in banking supervision today? Jelle, I'll let you go first.
Thank you very much, Naomi. Thank you for the very polite introduction. I just wanted to add that Better Finance stands for more than 4 million individual investors in Europe. I think it's important to mention that again. And also thank you to ECB for having me here. So it really sounds a little bit philosophical, to be honest. But what does public value mean for investors? Well, it's simple. It ensures that the financial system fundamentally serves citizens, the society, and the economy. And for the investors, it all begins with the financial safety. That's most important. Deposits must be secure, essential services like payments and credit must function reliably, very basic things, and very important, savings must not be eroded by opaque fees, inflation, or unfair practices. So from the investor's point of view, public value is inseparable from their financial interests. But maybe let me turn to supervision, because this is also very, very important with respect to public value. It ensures by enforcing procedures and upholding governance and conduct standards the public value. And I would like to give you 2 examples where this did not work.
Okay.
So we have the Wirecard case, which is the first case I would like to mention, and the Greensill case. You all remember Wirecard was the DAX 30 companies in the 2020, and it was a fraudulent DAX company which caused for the investors losses of more than 15 billion euros. This is only the shareholder side. And maybe you've read the news this morning. Our highest court in Germany, the Bundesgerichtshof, he decided that shareholders of Wirecard, unfortunately, do not have the right to any compensation. So this is really the case where households, private investors, are really hit by such collapse. I would also like to mention the other case, Greensill, because, why do I want to mention it? It's For me, it's a typical shadow banking case, and I think we should talk.
We will do. I'll let you mention this quickly. We're definitely going to come back to that later in the conversation.
So I don't have to explain, I think, the green sill case to you. I think it just shows that savers were sold products that they didn't really understand, that they didn't really know, and they didn't really understood the risks. And this is very important. So let us, Naomi, have a look at what were the lessons learned from these two cases, at least from the investor's point of view. Banking exists to serve society.
Yeah.
I think this is very important. And when governance, supervision, or transparency weaken, then there is only one who pays the bill, and that's the individual investor and not the banks. So,
thank you. Lots to unpack there.
And final remark, Naomi. I just wanted to come back, sorry.
You may.
To the very remarkable introduction by Claudia Buch this morning, because she said two sentences where I thought, okay, this is really great. She said, do not weaken the existing system. Do not weaken
yes.
the existing
I
system.
was also going to mention that.
And
so
do not
you.
water down the standards.
Yeah.
And I would love to say, thank you very much for this statement, because I fully support it.
Fine. Well, lots of this we're going to come back to and unpack. So thank you for setting the scene there. Richard, the same question to you. Public value in banking supervision. How do you see that? What's that for you?
Maybe I'll just start. I mean, the discussion today has really been about traditional banks, deposit taking, lending. And just to give you the perspective, because a lot of my comments will reflect my own history, which is obviously 4 decades with Goldman Sachs, and we do take deposits and we do lend, and we do lend to people buying homes and mortgages and those sorts of things. But we're also a big capital markets player, and that adds a slightly different dimension, and I'm sure that'll come through in some of my comments. So I just make that point. Of course, you're asking me, after 4 decades in the industry, whether it adds any value or not. It absolutely adds value. I'm convinced of that. And if I look at Goldman Sachs as an institution, we've been around for 156 years. You wouldn't be around for 156 years if what you didn't add value. So I think that's the overriding point. We're here to service the economy. We don't stand here as principals. We're here to service our clients. What is our purpose? In a way, we oxygenate the blood that's flowing through the economy. We help create jobs. We help facilitate growth. We help companies, our clients, individuals, our clients, governments, our clients, achieve their objectives. We don't determine what their objectives should be. They do. They've got their own governance structures. But often to achieve those objectives, they need finance. And they come to us as a bank, and maybe it's off our own balance sheet. We do lend money. Or from the markets, and we access the markets and we access that capital for them. Yeah. And so, that is what the industry broadly does. It's an essential part of driving economic growth. Economic growth has probably never been more necessary than it is now, and obviously that comes to some of the regulatory discussions that I'm sure we'll touch on. But it's an essential part of our economic model, and I can't think of a better way to do it. So I think there is absolutely public value there. I mean, I'll give you one sort of historic example because I was thinking back over the decades when I was talking Microsoft. So Microsoft went public at around the time that I started in the industry. They raised $61 million in their IPO. Their market capitalization at the time was just over $500 million. But they did that IPO so that they had access to finance, access to markets to help drive the growth. And you think what Microsoft has done in terms of driving efficiency, driving businesses. Today, this is a company, as we know, which has got a market value of more than $4 trillion. That's what the markets can help companies achieve.
Thank you, because I think there's lots we can talk about and lots we'll dive into, but I want us to keep to the lens of, we're talking about this, looking at this through the lens of How does this bring public value? How do we safeguard that? We'll move on. So there was so much there. I mean, bits I picked out so that we can keep the focus on this. You serve citizens and society. It's driving economic growth. It's creating jobs. Gosh, there's so much there. And you obviously both clearly believe in this. So we've established that. So I want to move on to looking at how we protect this public value and safeguard it. I think quickly it's good to establish perhaps when we're looking at public value versus shareholder value, let's talk about quickly the differences there are in the way they're regarded and the balance between them in the US and Europe. Richard, I'll come to you. You know both things both worlds well, sorry, so talk to us about that.
We run a global organization. We obviously adapt to the local situation, but it's a global organization, so we think about this. We don't think about it much differently between the US, Europe, or frankly Asia. Yeah, I think these are large institutions now. They need to go to the markets for external capital. I'm talking about the banking sector. So you have to drive returns for your public shareholders. And so you need to earn more than your cost of capital. And let's call that circa 10%. So that, these banks need to drive returns on equity greater than 10%. And if they can drive those returns, they'll continue to attract capital and be able to put more into the broader economy. So it's essential that banks can secure returns. In terms of the public good, this is a highly competitive industry. There are many, many players around the world, and they're competing. And to the extent that you get to a period where there are excess returns, those typically get competed away. So I think we should absolutely bear that in mind. This is not a risk-free activity. At the end of one of the functions that we provide is we are helping allocate capital across the economy. And it's in a market-driven way. Not every decision will be the correct decision. You absolutely will make loans that you wish you hadn't made. But you'll hopefully make a lot more than you're very happy to have made. But this is not a risk-free enterprise. You'll buy equities that don't go up. They'll go down in value. Hopefully you buy a lot more that go up in value. But you're allocating capital into an uncertain future, an uncertain world. But you're doing the analysis, you have processes, you have systems, and you're diversified and you're managing risks appropriately, and so that's long-term sustainable. But we shouldn't sit here thinking that we can live in a world where bad loans are not made, bad investments are not made. That will happen. The future is uncertain.
Okay. Just seeing though if there are any key differences to bring out. I don't know if you want to add to that, Jelle. You know Germany well compared to the rest of Europe.
Yes, I think it's a very important point. I don't know well enough the US situation, but when I look at Europe, I see cultural and structural differences. And if you look at the European banking sector, it is shaped by a mix of public, cooperative, and private ownership. So I would dare to say shareholder primacy is not the #1 priority with respect to European banks. If you look at the German 3-pillar system, you have the saving banks on the one side that emphasize regional development. You have the cooperative banks that prioritize member welfare, and you have the private banks. And here we have only 2 listed German companies, Deutsche Bank and Commerzbank. So here we have the shareholder primacy, but I think over 60% of the German banking assets are held by public or cooperative banks. So I think the structure is a little bit different from the US, I would say.
Okay, so we have decided between us that public value is so important, and how then do we best protect and safeguard it? So my question to you is, how do you see the rolling of banking supervision and regulation in keeping this balance between private value and public value? Jelle, I'll come back to you, and then Richard.
Well, actually, I'm a very strong supporter of a well-balanced supervision, especially since our last banking and finance crisis in 2008.
Yes.
So I believe supervision is an essential tool for maintaining this balance between public and private value. Why is it important? Because it enforces prudence and risk management. It ensures governance quality. It prevents, hopefully, mis-selling and misconduct, and it safeguards stability and trust. Of course, banks naturally pursue profitability, but without a strong oversight, risk can be externalized then to the taxpayers, to the citizens, and to the retail investors, and that's what we do not want.
I want to just come back to this sort of shareholder primacy comment. You know, when I think about this, and I think about this for our own firm, I think about it for other firms in our industry, but frankly, for any business. If your starting point every day and your only focus every day is where the share price is, you're not going to have a successful business. You know, the question is the service you're providing one that's valued? To the first point, you know, the answer is yes. Do you have the right people? Do you have the right culture? Do you have the right systems? Are you competing in an effective way? Is it long-term sustainable? If you can build, I mean, I go back to my Microsoft example. If you over 4 decades can build a product globally that people want and need, price it appropriately, you can build a lot of shareholder value. But if that's where your starting point is, you probably won't get there. And I think you go back to the dot-com bubble of 25 years ago. We all sat around those tables, and people sort of started with the IPO prospectus and then tried to work back to a business model, hoping they could get something to the market very quickly. And it didn't work. It doesn't work. It never will work. So it's an outcome. It's not. You have to build a business and build a valuable business, and there's a lot that that obviously goes into that. So I really want to make that point. I think long-term sustainability is key, and for a financial institution, that's about having the right culture, the right people. It's about putting your clients absolutely first. That is your mission in life. You are here to service your client base, so you need to put them first. You've got to do it with integrity. And you've got to be in the risk management business. And that is about diversification of risks, avoid concentrated positions, don't have too much leverage, have sufficient capital. You look at the capital ratios today in Europe, sitting at around 14.9%. You look at the liquidity position, the LCR ratio, well over 100% for most banks, excess deposits, 1.8 trillion euros of deposits. So it's just in a much sounder place than it was in 2008.
Yeah,
but it's a holistic picture
that
you need to think about.
Yeah.
But it's long-term sustainability. On the previous panel, 100 years, 156, we want to be for another 156. That's...
I wanted to come on to that, of course, and sort of see what we've learned since then, what the state of things is. But I wanted to just sort of push again on the public value and the role of regulation in protecting that. Jelle said, I'm going to simplify, but which we're doing more of these days. She's a fan, but are you?
Simplify,
what's the role
yes.
of it?
I also
regulation and supervision to protect the public value. How important is it?
We have no ambition to make the world a less safe place. I mean, and I think we saw that in 2008. You could be in a car that's been driven safely, but if the other people on the road weren't driving safely, you'd end up in a bad place. So system-wide safety and security and soundness is absolutely essential, and the supervisors and the regulators and the policymakers play a hugely important role in that. There was a comment on the previous panel about policy volatility, and I was just reflecting on it, and I thought, that's right, there is a lot of policy volatility. And of course, that panel was focused on climate. But maybe sometimes we think we can have policy on too broad a sort of canvas. I mean, obviously, having the right capital ratios is critical. Having the right liquidity ratios is critical. Some of the stress. But none of us can predict the future. And I'm thinking, climate, I come back to this being a public good. The climate issue, moving towards net zero, absolutely critical. We got a $750 billion commitment by 2030. We're 80% of the way through it now. So we'll obviously go right through it. But if we could find the nuclear fusion answer and fund that innovation and have that go from a $500 million company to a $4 trillion company over the next, we would have done a lot to help. But we can't predict the future. Will that happen? Will it not happen?
And this is, I'm going to, yeah.
So investing and supporting innovation, it comes back to the public good.
Yeah.
But I think, but as an institution, and by the way, we may make that commitment to a firm like that, it may not work out. Is that a bad thing? You took a risk. Depends on the holistic size, nature, shape of your balance sheet, because you will take some of those risks, and that's appropriate. That's what we do.
You touched on slightly earlier about 2008, post then. I think I want us to look forward, but before we look forward, I want us to look back a little as well. I'm just a quick recap on what would you say the lessons we've learned since then, briefly, in terms of banking supervision and protecting the public good. I'm interested in that, and also you've been involved in banking before then, post then. What are you both seeing that's harder, easier since this regulatory push post 2008? Jelle.
Well, I think I'm very happy, first of all, to hear that you don't want to change any rules. So this is
that's
good news.
Not what I said. That's not what I said.
That was my interpretation. Maybe I wanted to hear this. Okay, 3 lessons I think which still stand out. The first one is crisis unfolds much faster than ever before. And we heard this also with several cases like the Silicon Valley Bank collapsing. I mean, everything goes much faster than in the past. And also confidence evaporates very, very quickly, which is difficult in an environment where you want to incentivize individual investors to go into these capital market investments. Well, secondly, consumer harm occurs whenever conduct supervision is weak. And that's why conduct supervision is so essential for the investors. Just wanted to remind you of the Italian bail-in, the mis-selling cases we also saw. Here again, we had failures that damaged the trust of the investors. And third, and I think I repeat this again, governance must be robust. The Wirecard scandal is a little bit the case where it was the contrary. So I think the overarching lesson for us is public value must be actively safeguarded, and investor protection should be also treated as one of the high priorities on the list.
Yeah, Richard, what do you see as the lessons learned where we are now, the changes you've seen?
Well, maybe I'll make 2 points. You go back to the crisis, and I think we will spend a lot of time on that. So I'm not going to add anything new here, but obviously it was all about concentrated risk, excessive leverage, weakening underwriting standards, and frankly the connectivity across the system. And maybe that's relevant because we might get into a discussion between private credit and bank lending. The fact is these systems are always connected, and you make a mistake if you just focus on this, because if this goes wrong, it might impact something over here. So there is connectivity. So that's point one. But the second point I'd also make, and no one's going to want to hear this, but banks will go out of business. Across every sector of the economy, there will be players who will go out of business. And I think it would be a mistake to try and create a system with the purpose of making sure that a bank can never go out of business. It would create massive moral hazard. It would create huge complacency. And I think that would be the surest way to see standards drop. So I think the question is, how do we accept that a bank will go out of business in the future, but it won't require taxpayers to come in and bail them out? It won't have contagion right across the economy. And of course, with the Credit Suisse example recently, maybe the Silicon Valley Bank example, there are some examples. I mean, who would have thought that we'd be sitting here? Let's go back 15 years and say, one of the globally significant financial institutions is going to go out, and it won't bring the whole system down. You'd have said that's not possible. That's what happened. So the question is, how do we have a system where there is moral hazard, there is risk, people are responsible for their own destinies, people have to make their own decisions, There's good, but there are also processes where if someone's going to fall behind, they can be taken out of the system without bringing the system down. I think it's a really important point.
Okay, so we've had a little look back. Now, this has been talked about lots already today. Where we are now, we're in this new complex environment, this heightened geopolitical risk. We've heard lots about it this morning. We've had this regulatory push. Banks are safer. But there are these new financial risks, many. And I suppose my question is, how do we preserve this resilience that banks have built up when right now we're seeing what some might say, I'm sure you might not say this, but aggressive deregulation that's happening in the US under Trump. For example, the Basel III endgame proposal, which is likely to be watered down or scrapped, which Goldman Sachs, amongst others, has pushed for. So how do we, given that there are all these new financial risks, things are changing so rapidly, as we've been hearing today, how do we preserve resilience? How do we move forward? Richard.
Yeah, I think we want to continue to live in a sound, safe, secure world and operate in that world. That's absolutely a given. Yeah, we're not asking for and have not been advocating for a weakening of standards. But I also think we should continually look at standards. Why are today's standards exactly the right standards? They may be too weak, by the way, they may be too strong. Yeah. The world changes, there's new technology, so I think as with everything in life, you've got to keep re-underwriting, are we in the right place? So I think that's absolutely appropriate. The Basel III endgame, of course, was much more about something that was still in the future. It hadn't happened yet. It was much more about gold plating. On the previous panel, people were praising Mario Draghi. Here I'll praise Enria, because he himself said that would have been raising the capital levels for US banks much higher than the Basel rules had said. So for our institution, it would have, we didn't see the final rules, but looking at it, that would have been a 20-25% increase in our capital. That just seemed excessive. And there's a consequence to that, of course, but that seemed excessive, particularly when you look back over the previous 10, 15 years. We'd been through the Russian invasion, the energy crisis, we'd been through COVID, we'd been through the Euro crisis, we'd been through annual CCAR stress tests, and at each point, the banks seemed to have sufficient capital, so why suddenly move it up 25%? And there is a cost to that, because you can raise capital standards, you can raise liquidity standards, but at the end of the day, the cost of that, because that's the input cost. That's like raising the energy cost for a manufacturing company. In the end, those cost increases will get passed through to the end user. And that has consequences. Pensioners will be paying more to transact in the markets. Borrowers will be paying more to get a mortgage. People who want to borrow to pay for university fees and school fees will be paying more. So that's not a good. The question is, coming back to balance, and that word's been used a lot today, what is the right balance to ensure that we are appropriately safe and sound, that the weak players can still leave the stage, but without infecting the others, but we can in the most efficient and the most cost-effective and the most suitable, because obviously the mis-selling, I'd be absolutely with you, there should not be mis-selling, get to the end consumer. That's what we're here for, to service the end consumer.
Did you want to add anything?
Yes, sure.
Please.
I think compared to 2008, I would say that European banks are much stronger today than in these times. But the major risks, in my point of view, lie outside. It's more the shadow banking, which is a real problem. And I think this is something where we have to take care of. And when these activities occur outside of the frameworks and outside of all the supervision, then it doesn't really help that much, since again, retail investors are also involved in these, or at least products are sold to the individual investors. And we at Better Finance, we always said, well, if you have the same activities and the same risk, why don't you apply the same rules?
Yeah.
It's not understandable.
Sorry, I don't want to cut into you. I want to talk about this, so but please.
I don't want to take away.
No, it's just
because I think from the investor's point of view, it's just not. We cannot understand it. You know, why do we have different rules? And we fear a little bit that the next crisis will probably come out more of the shadow banking.
Yeah. So definitely, I wanted to ask you that. I mean, we've seen, you know, the recent collapse of the US firms, First Brands and Tricolor. So it's kind of 2 points. I wanted to ask you: do you see these as one-offs? Or do we have the next banking crisis in front of us? How concerned should we be? And it certainly cast a spotlight on these non-banks that are involved in bank-like activities. So that's a question. And also then, should we, instead of a rollback of regulation, be strengthening it to include them? So,
well, I mean, I make two observations, I guess. You know, I mean, the first, if we're talking about hedge funds, private credit firms, asset managers, they are subject to a lot of supervision, not necessarily by the banking regulators, but there is a lot of supervision there. So we should come back to that, and we'll come back to that in the First Brands case. And so I think those are sort of well run, well governed, broadly well supervised. I think there are other activities that really used to be exclusively provided within the banking space, which are no longer provided only in that space, although obviously the banks continue to do it. But really it was, I remember the discussion about this in 2009, 2010. You know, these risks will still be taken. Do you want them taken inside the regulated space, where you have great visibility? Or are you going to drive them out of the space, and so they happen, and hence the sort of shadow banking terminology? So a lot of these activities are happening because the capital requirements to do them inside the regulated perimeter is much higher. So people can come. So the example to use would be these non-bank liquidity providers who are very active making markets across, the equity markets, for example, very big in the US, but big in Europe too, unregulated, different capital requirements,
so
different supervision, and I think that is worth looking at.
If we're going to make it a level playing field, then they should be included in the regulation?
Well, I think that it's worth looking at. I don't have the answer, but it does seem you've got an activity here where you need this capital, this liquidity, this set of rules, and over here you're in a very different place and you're doing the same. But I think you have to distinguish between these activities. You don't have to be in the, as I said, the hedge funds, the asset managers, I'm fine. So then let's come back to your Tricolor and your First Brands question.
Yes, thank you.
So, those were obviously two situations where the people who lent probably wish they hadn't lent. They've got to look at it themselves, and were the underwriting standards appropriate? Was there fraud? Was there something else? Did something just unforeseen happen? And it's probably a little bit of everything. But these things happening is not bad. A few speed bumps along the road gets everybody else to be a little bit more alert. Are my underwriting standards up to scratch? Am I thinking about this the right way? Am I being competed to a place where I'm taking more risk than I should take? So of course, you wish they never had to happen, but sometimes speed bumps prevent you having a bigger accident further down the road. So these are both unfortunate and probably regrettable, but broadly there's a message there. Go and re-underwrite your underwriting standards. Think about the risks you're taking. And I'll leave it there.
Okay. I'm looking forward to taking audience questions and seeing your comments and questions on this. Did I give you a chance to answer as well? Yes, please.
Maybe just one point, which I would like to mention. I'm personally a fan of simplification, less bureaucracy, especially in Brussels. I agree on this. But when I look at banking, I'm not a supporter of deregulation, to be very honest, because that's something we learned from the past crisis. And you said, and I think this is very valid, I mean, we talked about AI this morning, about cyber risk, about shadow banking, and I think regulation develops. And we will, of course, will also have to develop rules for these new fields. So I think regulation will not stop, it will not necessarily increase, but we will have to expand it to these new fields.
Yeah. Thank you. That also brings me nicely on to my next question, which is looking ahead. with these new challenges, AI, fascinating discussion on AI earlier. So financial innovations like stable coins, you know, so much of this coming at us. I suppose my question is to both of you, looking ahead the next 10 years, I mean, obviously things are happening so quickly, things are unpredictable, but what would you see as the biggest challenges ahead through the lens of how we protect the public interest in banking along the way? Richard.
Well, I absolutely support the comments made earlier that, you know, sitting here in Frankfurt, our priority should be banking union and savings and investment union, and whatever else needs to get done to achieve that. So I think that's absolutely, you know, first priority. And then second, you know, global competitiveness. You know, the world is moving forward. AI is going to unlock opportunities that we can't currently see, and I think we need to, I'm not going to rehearse the conversations that we had this morning. I'm not going to predict exactly how it's going, we don't know, but it's obviously going to change, and to the extent that we can, you know, we all employ a lot of smart people, and to the extent we can have this technology help them do their jobs more effectively, more efficiently, provide better service to our client base, that's going to be a great new world, so we obviously have to embrace that and seize it. So I'd focus on those two. And then I think we have a set of rules right now, capital, liquidity, otherwise, which are fit for purpose. We should continue to revisit their appropriateness. There may become a time we're going to think they need to be higher or maybe lower, but you know that feels set, and just keep the system safe and long-term sustainable. So those would be three objectives.
Thank you. Jelle.
Yeah, maybe just 2 points that you already mentioned, but I think they are very, very important. First point is, yeah, we have to complete the banking union. That's one of the reforms and the next steps that we need. We also have to introduce the European Deposit Insurance Scheme, EDIS, and it is not understandable for retail investors that you have uneven protection across the member states. So you need a single market with single rules and single protection. Secondly, that's the Capital Markets Union, or we're not talking about this anymore, we're talking about the Savings and Investment Union, which is the same thing. We expect that investors are needed because the finances of the EU will have to need a lot of billions of money just, you know, to build up resilience, to build up defense, to introduce the capital market. And for this, you really need the right standards, you need the right incentives. If not, European citizens will not invest in the capital market. And we have to bring an end to, and this was mentioned this morning, to the fragmentation of the markets in Europe, which is still not a good idea. And therefore, I was grateful that Chancellor Merz at least mentioned that there could be a merger of some stock exchanges, some important in Europe, because that would bring us already a little bit forward to avoid the fragmentation.
Yeah. Thank you both. We have a few minutes. You heard from our panelists. Do you agree with them? Do you disagree? Comments, questions? Yes, I can see your hand up there at the back.
Good afternoon, Stephen Wolf, ECB. So maybe we've heard a lot of talk about the value from the banking sector. Maybe to flip it on its head, the value from a supervisory perspective. So our failures are always very public, our countless successes are private. So how do we measure public value?
How do we measure public value in terms of the supervisory
world? Yeah.
Okay. Richard? Richard? Yeah.
How to measure?
Well, you chose the life that you're leading, so you're obviously a believer in that. And I look from our point.
The reason I asked the question is, how do we justify our existence to the political powers so we don't get shut down?
Oh, okay.
I don't think that's likely to happen. You know, one of our most important partnerships that we have is our partnership and our interactions with the supervisory infrastructure, you know, both here in Frankfurt, but frankly in New York and Washington and London and, you know, and out in Asia. And I look at this as a partnership. I think our objectives are all absolutely the same thing. We've discussed, you know, the public good, the importance of finance, how that helps facilitate all the things that we discussed, job creation, growth, etc., innovation. in the previous panel, we talked about €1 trillion of finance annually being required for the investment in the transition. That's going to require this industry to really step up. This industry has to be long-term sustainable. Our partnership with you can hold the mirror to us. You see the entire picture, we see our own picture, so you can add significant value. And we really look at it as a partnership, and I think together, if we can work together and keep those communication lines open, you obviously executing on your responsibilities, us on ours, we get to a better place. But I think when you're in the protection business, there are other people in similar positions. That when I talk to people in the intelligence services, as they say, we only have to make one mistake and we're front page news. The 1,000 issues that we caught before they were executed on, no one ever knows about. So that's the life you chose, and thank you for doing it. It's a hugely important job, and we all benefit from it. So thank you.
I feel like I want to end there because that's just a nice way to end. But if anyone had a burning question, I don't see hands, so it's perfect. That's a really great way to end. Coffee's on its way. But please join me in thanking our panelists. Thank you so much for being willing to discuss it like this. It's great. Thank you. Please stay here for a moment. Stay here. Thank you very much.
They're ready for a fight.
Thank you very much, Naomi. Yes, coffee and tea is served outside. We will be back at 4:15, 15 minutes past 4. Thank you very much.
Welcome back for our last panel of the day, Resilience in Action, from Setbacks to Strengths. Banks have remained remarkably adaptable in recent years. This panel will explore how sustainable this resilience is and how much traditional banking will change in light of new competitors. Let's welcome the moderator Pedro Machado and the panelists to the stage. Pedro has returned to the ECB as representative to the Supervisory Board after a long career in financial regulation and supervision. Among others, he served for 5 years on the Single Resolution Board and worked at the Banco de Portugal and the European Investment Bank. Pedro will introduce the panel members and invite you to join the Q&A.
So, good afternoon again, and be very welcome to the closing panel of the first day of the ECB Supervision Forum. We will address in this panel an issue which is, I think, always in the minds of many, and in particular, I think, has been also in the minds of those that have intervened before in this conference, but not explicitly said, which is the issue of resilience. We know that today, and throughout this conference until now, we have been talking a lot about risks and an evolving landscape, which ranges from geopolitical to climate risks, from technology-driven operational risk to cyber risk, which prompts the issue of cybersecurity and cyber resilience. But it is also fair to acknowledge that banks have faced a series of challenges in recent years and still have remained remarkably adaptable, which might have not been by chance. And this is something that we also will try to discuss in this forum. So we will have basically sort of 2 core questions that we'll try to go through during this panel. The first being, what is the role of resilience in the light of evolving risks and innovation? And then the second looks a bit at the current challenges and the current competitive challenge as new competitors and methods and business models challenge the status quo. And so there will be, the question is, to which extent there will be space for traditional banks in the future. To discuss these questions, and I'm sure many other aspects that are related or interrelated with resilience, I'm very happy to be joined in this panel by, I would say, a remarkable representatives from different parts of both the industry and the regulator. So here I'm first joined by Fiona Gallagher. She's Chief Executive Officer of Wells Fargo Bank International and the International Head of Commercial Banking. She's active across the financial service industry and beyond, and she's chair of the Women in Finance Charter Committee in Ireland. And I'm also joined by Charlotte Gerken. She's Executive Director for UK Deposit Taker Supervision at the Bank of England. And at the Bank of England, she chairs the main executive committee taking decisions on supervision, policy, and risk issues. And further to this, she's also a member of the Basel Committee for Banking Supervision. And then Wim Meijs is the Chief Executive Officer of the European Banking Federation, and is also the industry chair of the European Parliamentary Financial Services Forum and the board member of the Salzburg Global Forum. So I'm really very honored to be joined by you and that you have also accepted to come to the ECB forum, Supervision Forum, to share with you, with this audience and the audience that is, by the way, connected virtually, to share insights and to try to delve into the issue of resilience. And so maybe we could start really by the question of resilience, and since resilience in banking has traditionally focused on capital strength, liquidity buffers. It is also the case that today, when we took it, or have a bit more of a broader perspective, resilience also today, when we discuss it, I was saying, has also to encompass adaptability to innovation, operational shocks, and reputational risks. So as this risk landscape evolves, so must the definition and the measurement of resiliency eventually complemented with qualitative measures and in particular also judgment be addressed. So with this, I would like to start with Wim and asking you, Wim, what indicators best capture a bank's ability to withstand and recover from non-financial shocks?
Ooh, thank you for your question. I must say, when I first got the question, I was rather nervous because capital and liquidity indicators have been with us for a long time and the metrics are well known and well researched. But I was inspired by the discussion this morning, by the speech of Claudia, of the adaptation and different ways of looking at how technology impacts risks, how operational risks is developing, and cybersecurity. And by the first panel, who indeed realized that digital is with us and it comes with new risks. But so I will try to give a number of indicators, because the first step is close cooperation between the banking sector and its supervisor. Because, and I'm quite happy to say that with the single supervisor we have an excellent relationship, because you need to start by really trying to understand and grasp what kind of indicators will be useful to measure both from a risk perspective but also from a supervisory perspective. And I must say that the stress test that was done 2 years ago by the SSM, and the way that was done, as also partly as a discovery exercise, was quite useful for that. So let me discuss 5 areas of indicators in a quick response to your question. For me, a number of questions. If you are hit by an incident, the first one is how fast can you restore your critical services again? And there are indicators like that, like the recovery time objectives, and indicators that are quite objective in the way to measure that. But that is the first area. The second one, and another important one, is in my view the speed of detection and containment. How fast do we realize that we are under attack, and how quickly is the area that is affected contained? And again, that is measurable, but you can also go into the governance of the bank and the ability to decide. I give you one example that I ran into many years ago, is that there was a bank who had a cyber incident, and they had a perfect internal reporting system. And it took only 15 minutes from incident to incident being detected to the managing board being reported to. Except that after the incident, when they evaluated, they found out that their web care team was able to detect in 2 minutes. And so it's important that you take these indicators then back into the bank and you realize that speed of detection is important. Then, of course, data, protection and recovery of data. So again, you can also get that in very clear indicators on how you're able to protect your data. But also, and we've seen that recently with the DNS problem of Amazon Web Services, your failover success rate. How quickly can you adapt or change to another region if a region is under attack or has a problem? Then the fourth one for me is very much governance and the decision-making speed. So anybody who's, the moment they are taking the plastic off the manual, the moment an incident occurs, something is wrong. And the fifth one, and that is also covered, for instance, in Europe by DORA, is how to deal with third-party providers. So I think that in these 5 regions, you can create indicators already, and you can be relatively precise. And by doing that in close cooperation with your supervisors and learning, I think we are able to create quite clear indicators that are also very useful for supervisory practice.
No, indeed, no. I think you are also repeating or recovering some of the the topics that were mentioned
Absolutely.
early before. And
Absolutely, I was inspired.
Yeah, exactly. And so it's good that we can also close taking also inspiration from the beginning. So very well. And just maybe picking on this because you mentioned issues that are boding or resembling or resonating to operational resilience. I wanted to ask Charlotte, how do you see from your experience that banks have been balancing innovation with operational resilience and of course with the regulatory expectations or eventually also the supervisory expectations? But how do you see from your experience that this has been sort of coming to terms?
Thank you, and thanks very much to the ECB for inviting me to join this panel today. I've really enjoyed today's conference so far. I did just want to pick up on Pim's comment about cooperation, because I think when we at the Bank of England really moved from an approach focused maybe more on operational risk to operational resilience, so the assumption that bad things will happen, and it's about how you recover. It has very much been an approach developed with industry, and we do have quite formal and informal fora around both the preparation for events, but also then when certainly big incidents happen, how the industry actually comes together. So I would agree with that. On the balancing innovation, and has been quite a lot mentioned about balance today. Balance may suggest a sort of trade-off. I think on innovation and operational resilience, it can depend on the motivation for the innovation. So I think innovation and operational resilience can be in balance when innovation is an opportunity to build in resilience by design. There's that opportunity, and certainly for new players not encumbered by, say, legacy systems, to really build in that resilience as they innovate. But if the motivation is maybe a more immediate sort of cost reduction, then rather than longer term, then that innovation and operational resilience may come into tension. And say some of that kind of may be happening around how some banks have seen their use of third-party cloud service providers as a way to, say, reduce costs. It's been a way of enabling more innovative use of their data, but then does the contract they've got with the cloud service provider really enable them economic ready access to the data? So I think it does depend on that kind of motivation. I think the balance between innovation and regulatory expectations is something that we're pretty focused on at the PRA, and we have to be, as we've got a secondary objective around competitiveness and economic growth, and both those associated with innovation. So we have to consider innovation when we develop any of our regulations, and we need to strike a balance between sort of predictability and certainty in the rules that will give firms the confidence to invest. But there is a balance between that and having rules kind of flexible enough so that firms can innovate.
Yeah, indeed. It's always the challenge of keeping innovation safe, but also not stifling innovation. So yeah, and maybe with this is a good hook to come now to address Fiona, and in particular from your experience, of course, and I think it's from the bank that you coming from, for sure that it's very representative in terms of the experience that you can share. But how do you see that on the base of that your bank is embedding sort of resilience in terms of your strategic planning and the governance framework? How do you see this been evolving over time?
Great, thank you, Badru, and again, thanks for the warm welcome. So, listening to this morning and listening and considering the topic, it feels like we were living in simpler times when all we had to consider was liquidity and capital. Now it's really, to your point, how can we adapt to change, but also how do we handle those unexpected disruptions, and then most importantly, protect the reputation of our clients through the bank. And risk is just changing fundamentally. So whether it's cyber, whether it's tech failures, or whether it's that loss of public trust, we fundamentally had to revisit how we define and measure resilience and look at how we change it in terms of our approach. And so first of all, it's really, as we've been talking about today, starting with the real life experience of how a bank has reacted to an issue. To Wim's point, how quickly they react, how quickly they communicate, and how did we, or the bank, respond to something when it went wrong. And that's really the best situation to figure out how we should look forward. So we try not to look in the rearview mirror, but obviously it's very important when there is something that has gone wrong that you take that after action review and you really look at building that into the future, because those are the elements that are very unpredictable and were very unscripted. The next best thing, and we've been doing this a lot, is obviously testing. And so, you try and avoid the scenario, just the tabletop scenarios, but actually really try and do a live fire drill, and you try and make it as complex as possible. We recently did, and I'm using my new terminology, war games. We recently ran a war game within the EU entity. And it was interesting. First of all, the cyber piece went quite well. We could understand what we were doing. We were well briefed. People understood that they shouldn't go deep in trying to solve the cyber issue. Our issue was to respond, and our job was to respond in a different way. But we actually very quickly started layering in other elements. So yes, we had a cyber issue, but we still had to make payments for our clients. We had KYC challenges that we couldn't actually see. So what were our responsibilities? And it was by adding in the layers into that scenario that we really saw the true challenges that were coming out. And so then taking those points, it's really looking at how do we embed that into our governance frameworks and also into our models. And I think historically, we've looked at operational risk or resilience really from a BCP or technology perspective. Now it's about putting it into everything we do. And to pick up on your point, Charlotte, it really is in the design phase. So for example, new product that we're designing, we know it's got to make lots of payments, for example. So that's very straightforward, right? We put it into the design, into the controls, into the computer system, into the database. But now we actually need to think more broadly, really a broad-based approach. So we're looking at our vendors, and the approach that banks would normally have taken is where's the best talent, where's the cheapest provider, and now really that's not the case. The starting point when we think about our vendors or third-party relationships is around concentration. So again, it's layering all the different elements to come up with an approach and then putting them into your governance frameworks. But also importantly, they have to be dynamic. You keep having to come back to them. And also you need to keep looking at them with the lens of maturity. And I think when you do all of those sorts of things, you really will emphasize how you need to adapt, but also you're very conscious of the internal processes, the external stakeholders. But it's not one and done. Every exercise that you do has to come back. But I think the biggest issue for us now, as I said, is all the complexity, but particularly around the vendor space or indeed the digital space. But I do think the advantage when we think about innovation and digitization is that we're designing things now. And so again, we can layer in those processes or those frameworks really today and make sure that we're taking that broad brushstroke.
Yeah, indeed. This is very interesting that what you're saying, in particular also the issue that the relevance or the importance of also testing, so conducting fire drills, dry runs, which I think are of the essence in terms of readiness and preparedness for coping with these shocks. But also you mentioned a point, and I just don't resist to see what are your views, is this third-party service concentration that we have in terms, in particular for cloud service providers. To which extent do you consider the sort of robustness of the mitigants that you can put forward, and also in particular thinking about in terms of the leverage that you can eventually have in terms of the contractual negotiation. Do you come across with this challenge?
So I think a big thing, not only for us, but across all of the larger banks, is now really the red line with regards to vendor management and outsourcing. Historically, you might have liked to work with someone, and if they're, if the arrangement or the contract was 90% there, you would certainly think about, look, that's something that we can do and something that we can execute. What we're now seeing systemically is that there is no appetite for that, that you're setting the benchmark and you're really working with the industry, you're coordinating to talk about best practice, and then you're really trying to drive that through with the vendors. I would say we're not always 100% successful, but that really is from, CEO down of the group, that really is the approach. And I think it came across very strongly in all of the panels that this approach, whether it's outsourcing, vendor management, all of the additional elements, all of those now, those key decisions are at a group board and executive level. Historically, we would have thought about, let's say, procurement, and it would have been managed perhaps at a much lower level, whereas now it is absolutely critical that it's managed at the top. And any decisions that move away from that kind of red line, really can't be taken by individuals who mightn't see the broader impact.
Yeah, I see these decisions being taken as board or strategic issues, and not just the operational resilience side, but just the business critical, the link to, say, geopolitical risks as to determining where you might want to take your business may depend on where your third party sort of cloud provider is, or indeed other suppliers as well.
Exactly. So, and there you can see how also then this shapes governance. I mean, as you rightly say, that this of course requires certain governance changes. And with this, maybe we can move to, and I think this was a very good starting point to frame the discussion. And now taking a bit to the perspective of the supervisors, how we are seeing, and also I would be interested to hearing to you. But it's true that the supervisors have been sort of focusing on resilience as a systemic safeguard. So, and as we said at the beginning, this is today not restricted only to financial soundness. We have this critical dimension on operational continuity, cyber resilience, and of course this will, as we just saw, shaping also then the broader governance framework within the banks. So the challenge here also lies in aligning sort of supervisory expectations with also the pace of change in the industry. And here, again, Wim, if coming back to you, how do you see that banks can demonstrate resilience, but without relying solely on quantitative metrics? I think this is close to your heart.
I've always wanted to put on the hat of a supervisor, so this is my chance, and I'm in the right building. But going back a little bit on concentration risk, because one thing is, for me, moving to cloud services was not so much cost, and also concentration risk. I'm still from the banking area when we all had the same IBM mainframes running all on the same software. So in that sense, we come from an era of high concentration risk. The difference was, of course, the physical ability to deal with the data, both for the banks who had them in computer centers and for our supervisors who were able to check the data and check the computer centers. But for me, the reason to move away from that is pure survival. If you look at the ability of cloud and data in the cloud, both cyber resilience, updating, patching, the whole system, any bank that still relies on their old computer system is at huge risk, in my view. So that is, for me, the big step forward. Now, indeed, many of you will have been in cybersecurity centers of large banks, and it looks a little bit like the control center of Houston. And that shows the value of metrics, because there you constantly get, everywhere in the group, you constantly get on these huge screens, you get data and direct cyber incidents, and you see what's happening elsewhere in the world. Now, from a supervisor's position, actually, I think that Fiona just demonstrated exactly what you should do towards your supervisor, because it starts with good governance and clear roles. Who is responsible when? And again, I give you an example. I've been in this for some time, and I remember doing a national exercise where the critical escalation committee started discussing its mandate during the crisis. Wrong. Yeah, it sounds simple now, but it actually happened. I must have looked pretty stupid when I saw that happen before me. So clear roles and governance, again, very much as was said by the other panelists as well. And from that comes fast decision making, but also the running of simulations, the war games, the red teaming. But that needs to then institutionally being demonstrated, that it's being taken, that it's a learning organization, so that the results of these war games and red teams are not just a nice afternoon out, but that they are really and physically then implemented in the organization. Then indeed, again, what was mentioned, it starts with infrastructure design. How do you design your infrastructure, and are you realizing what you're designing? And so indeed, the resilience should be built in already in all the designs. And then finally, again, for me, it's a learning capacity. I run together with the SSM, a CIO roundtable in which the CIOs of most European banks are part of, and we discussed the stress test and the results of the stress test as a learning exercise. Absolutely very important, but also black swan events. So what happens if one of the big banks in Europe gets hit by a ransomware attack in one of its liquidity critical departments, like the Treasury? Then we have a serious problem. And again, the reason why this is so important, and I cannot stress that enough, these are not problems of an individual bank, these are problems of the financial system. And that's why we need to communicate so openly on that level. But then also, indeed, the concentration risk. And that is indeed where our competition authorities come in, and we are in close cooperation with them. Because, in my view, we have to create some kind of power to countervail, certainly also the large vendors that may be under geopolitical pressure as well. And we have examples of that. So there is political risk involved as well. And this is again where we need to closely work together. So in short, we need to demonstrate very clearly in our governance that we are able to deal with operational risks. And that is what I would want to see as a supervisor and clearly demonstrated by the supervised.
Indeed. But I'm very happy that you say that stress testing is also a learning exercise. We'll take this as a good outcome of this.
If I'm fired after this panel, I said something wrong. But I actually, in cyber, I absolutely believed in that. By the way, it is also a learning exercise for the supervisors.
Agreed. Point taken. Charlotte, when we see this innovation unfolding, which also brings new players into the market, to the sector. Are you concerned of eventually possible uneven level playing field momentums or instances between the traditional banks and the new challengers, in particular because of different regulatory requirements that these latter are facing?
I supervise quite a few hundreds of deposit takers from sort of the largest global systemic banks to very small sort of amateur-run credit unions. Everybody feels that they are on the wrong end of the playing field. So I think whether the state of the playing field, there's different views. And I suppose the concern kind of may vary as well depending on what sport you're playing. I think I better leave sports stuff there because that's as far as it goes. But I know, there's a bit of a difference whether you're playing lacrosse or lawn bowls as to how level the playing field needs to be. So I don't sort of spend too much time sort of worrying. I mean, I get a lot in both ears on the levelness of the playing field. And we do have a considerable competitive sort of landscape. But the focus for me as a regulator and supervisor is, what is the risk to financial stability, and holding that in mind. So what is the impact of the player on financial stability, or what is the impact of the particular service on financial stability, because it's not always sort of about the balance sheet size. And we do have different requirements depending on the answer, and deliver those requirements through proportionate supervision. And that's intended to support growth, but also not undermine resilience. So it's more straightforward and in metrics terms to talk about the financial resilience side, where proportionality is codified through regulatory thresholds. So we do have, say, different strategies for dealing with bank failures, depending on their balance sheet size and the number of the volume of transaction accounts they have. And in the UK, we've deliberately set up a regime for small domestic deposit takers to simplify sort of regulatory requirements. So sort of help them not spend so much time worrying about the complexity of regulation, but spend time sort of growing their business. And similarly, we have as well as our new banks startup units, we've just launched a scale-up unit as well. So that is a deliberate sort of effort to support those firms at the smaller end. I mean, for operational resilience, we did take a conscious decision to have the requirements for all banks and insurers as well, but those requirements are applied proportionately, and again, that's how critical their services are to financial stability. So my concern is more where a product or service may look the same to a customer or market, but there is a different level of protection or security or rigor. And whether the incentives for the market to take those into account are kind of really accurately and well informed as well.
Mm-hmm. Yeah, indeed. Now, we mentioned before, and now, I mean, coming back on the issue of resilience and the impact of in innovation and technology and sort of keeping operational resilience of the banks. Clearly, there is also an issue that sometimes is very much neglected, but I think this morning, at least in the first panel, this was mentioned, and I think it's an important one, is the sort of banking culture that enables innovation to be incorporated in the processes, but with the adequate sort of frame by the adequate safeguards. In your experience, Fiona, what is really here the role in this particular case of building a resilient banking culture for leadership? How do you see the role of leadership evolving and being sort of more relevant to build this or to contribute to this sort of resilience framework?
Yeah, so no, thank you. So I think it's absolutely core, and I was thinking about it earlier. We talk about you can buy technology, but you certainly can't buy your culture, and I think that means that culture and leadership are intertwined, but also there has to be ownership at the top on all the levels. Speaking organisationally, we obviously have gone through about 6 years of significant change in my own organisation, and it was really led from the front. And sometimes that meant there were, forthright or blunt conversations, but it was all about transparency, all about the goal, all about a clear plan. So a lot of detail, a lot of ownership, no surprise to everybody. It's about the Monday morning meeting where you really talk through what has to be done this week, and then you come back to it next week and you speak about what went wrong and how can we solve that. And there's really no substitute for that. And I think when you're going through a challenge or you're doing an after-action review, whether it's a transaction or a crisis, I think you quickly have to identify as well whether you have the skill sets within the organization, so bringing in expertise perhaps on controls or design, but also as well as that, you need to create that followership. So I think one of the things that we've seen importantly in our own journey over the last number of years was promoting the talent within, as well as marrying that with regards to the expertise that you might bring from the outside. The other thing as well, and particularly if you think about resilience and culture and interaction with the supervisors, I think it's critical that we see, that open communication, that transparency. Also, as well as that, as much as you're bringing the team inside in the journey of the change or the resilience or the remediation, it's also about being very clear with regards to the regulatory landscape as well. There was an article last week which described, I think, our 3,000-page plan for change. 28,000 people who worked on, a lot of the remediation within the firm. But again, that was led, by all, led, and again, explaining the why of why you're dealing with the challenge and how you're going to do that. And then the other thing as well is recognizing, particularly for banks, that if you have a crisis, you still have clients, you still are trying to drive revenues forward. So when you're in the midst of a big challenge, you have to figure out what to do so that you're not standing still. In the case of our firm, we had a public asset cap, so it was how could we continue to grow the business without having the impact on the asset side. So we were talking about it earlier, this time of year means everybody's extremely busy, but the one thing that we are very conscious of is that when you're in the crisis, that you also have to protect the business that you have. And a large part of that is through communication. But if you do not have clear expectations and clear deliverables, and you're just relying, for example, a case in point was this morning's panel, if we're going to rely on AI to solve our problems, that's not going to do that. We're going to have to see what AI can tell us about potential solutions, and then it'll be up to the people to deliver and to integrate. So I think culture and leadership is key. It goes back to the panel just before us. We've learned a significant number of lessons since 2008. And I think culture and banking culture and the improvements and focus on it are probably the largest areas of focus. And I think positive improvement that we've seen.
Yeah, this was one, exactly. I was also kind of impressed in this morning's discussion to see the awareness or that digitalization, but in particular technology-driven innovation and embedded in the whole business model in the process also requires eventually much more availability at C-suite level. And clearly this seems to be now a sort of also condition, which is not coming from the supervisor necessarily. It's something that you would agree that is something that is felt within the organization.
Yeah, I think that's a really good point. I think if we're dealing with a lot of corporates, we're dealing with a lot of financial institutions. If you went to any firm now and they told you they didn't have an AI strategy, I think you would be extremely nervous. And so we can't have that expectation on the clients that we deal with without having that expectation within. We spoke about it actually at lunch, which is certainly if I look at my own firm, we have, like everybody else, Copilot is in. We introduced it slightly more slowly in the EU to make sure that we were doing it in the right way. But actually, it's encouraging people to use it. So to the point I think Andrea made of, how do you get the more senior, maybe more longer tenured people in your firm to get using it? You don't just say it's about the work that you're doing. Talk about, bring in simple things so people just build up the familiarity and also, just get used to using it day in, day out. We, for example, have just built, over the last couple of years, a new system for our commercial banking and investment banking clients called Vantage. And we sat there. AI was designed at the beginning, but actually the reason it's been successful is that we just didn't build a system and hope that the clients would like it. The first thing we did was design personas of every type of client and person within the client. So somebody from operations who might require one type of information from the system, a CFO who might be looking at something else. And when you understand your clients, you design those personas and you bring it together with the innovation and indeed the sandboxes that we're seeing. It really creates a much better product. But again, you have to have that client knowledge to tie in with the artificial intelligence piece.
I don't know, Charlotte, if in the UK you're also feeling that the banks are feeling this growing need also to escalate the sort of leadership in terms of technology, now that we are going forward, all banks are going forward with AI embedded functionalities, tools. Are you seeing the same sort of trend?
Yes, certainly. I think some of the largest banks, I think as Fiona says, not deploying AI is a kind of reason to worry as well. And we do have some of the sort of mid-sized banks actually asking us, are you going to develop more regulatory expectations on AI? Because these developments, they do take investment. So there is a point in scale for firms. So say some of the some mid-tier firms who may not be so designed into sort of innovation, kind of wondering what might be the constraints that a regulator may put on AI that could perhaps stop others moving ahead so rapidly. So to date, we've been technology agnostic and using our existing rules to address some of the risks in AI, recognizing the opportunities. So we've got, I think governance is where it needs to start. Accountability for decision making, model risk management, data. So we have got expectations in those areas. I think in time, artificial intelligence is different, and certainly the sort of the challenges actually to governance and accountability are such that I would anticipate sort of more AI sort of specific expectations coming in. But as Fiona says, we're learning as well. We're deploying AI in our business, and I think it's really understanding it from the inside before then working out what are the appropriate sort of regulations. And cooperation, I think, again, with the industry will be important.
By the way, and I cannot resist, Wim, do you think also, and I think because Charlotte made a very good point in this sense of that AI maybe is going to raise a challenge of its own. I mean, that...
I absolutely agree. Absolutely. AI is a challenge of its own. And at different levels. It first starts a little bit like, sometimes I have a feeling that there is a fear of missing out. There's so much talk, and if one person asks, what are we talking about, you get silence. So that's one. The second level is that AI can really also have serious risks towards your clients. So if you have a wrong, and we all know that, if the algorithms in these large language models are wrong, then you get redlining or you get exclusion, and this would be detrimental to the reputation and the service of a bank. So yes, it has all sorts of problems. Then you have all sorts of vendors who come in and think, okay, these people are above 30 years old. We just sell them process optimization at a high price as if it's AI. So at several levels, it's a huge challenge. But the interesting thing is how to use it and how to develop. I personally do not find Copilot the best example because it sometimes reminds me a little bit of the Microsoft paperclip of a few years ago. But there are clearly large language models that really help, and to get people to engage and to see the possibilities on one hand, and on top management to be really well informed and interested on where it can actually help clients and processes and not introduce new risks, that's essential.
You could switch off the paperclip there. I'm not sure you can switch
exactly.
off
Copilot. No, it has been exactly. I've been trying that. Yeah, exactly.
I was going to say just two trends that I'm noticing, which are interesting and tie into your point, is you're talking about a round table of CIOs, but recently we have, obviously CISOs, but the latest thing is cyber human defense. So a lot of us have now, new teams built not just on looking externally, but looking within internally to make sure that we are capturing the human risk within, but also starting to teach, we had Cyber Week in October, starting to teach people how to observe what is AI and what isn't. And I think that's a skill set that we will all need. And then the other thing that I find interesting is just over the last couple of weeks, there's been a lot of announcements about branch expansion in different locations.
Exactly.
And I do think it's something that we will see the benefits of this, but as we also see potentially the risks of AI, will that drive people back into branches, particularly for some of those decisions? So I think it's all of that. We're very much learning, but I think 10 years ago we would have said branches will reduce. We're seeing expansion everywhere. Part of that obviously to deposit gather, but equally I also think there'll be a secondary advantage of people getting back into in person. Again, cyber human defense was new for me, but it's
this is
certainly
super important, because also in the recruitment process, let's just say I go crazy with the amount of application letters for a function that I get that praise me on my inspiring leadership of the European Banking Federation. And that tells me a lot, namely that ChatGPT is applying for the job and not the person who says they are applying. Sorry.
Remember that.
Exactly. I go crazy with that. I all hire them, Frank.
So that's let's hope you will not end up being replaced by AI. For sure, you will not. But coming back, and by the way, I think here one important point that building on what you just said, Fiona, but also with what Charlotte said, we are also engaging, from our perspective as supervisors, we are also embracing AI, and I think the value in particular of training is of the essence. We also heard this morning, and I think it's not only training on AI, but there is also maybe a part of a generational workforce that has also to be trained to cope with this innovation. But I think this is one of the findings, the relevant findings. So I think we don't have much time left before I have to hand over to the audience. Which we'll with pleasure. It's not a duty, but I wanted just to have a sort of wrap-up final question, because we talk about many issues which are sort of ramifications of resilience. So resilience really has many sort of dimensions that we touched upon a bit in loose terms, but I think this was a bit the richness also of being in the panel, and it's a bit more, how do you see, and now a bit in a candid way, that with all this landscape under which we are evolving, from this more challenging, evolving risk landscape in terms of the new risk drivers, to an environment which has to be more agile, more tech-driven, and which will lead naturally to new players coming as they are challenging. How do you see that the possibility or the sort of strategy that has to be adopted by traditional banks to remain competitive? And of course, if there is really a space for traditional banks in the future. Who wants to start?
Well, the question is what you call a traditional bank.
Yeah.
Because the laws of evolution apply. If you don't adapt, you're extinct.
Yeah.
And that is, I think, the first. And I see banks adapting very, very quickly. So for me, it starts with for me, the fact is banking is a profession. It's not just like if I put on a white coat, I'm not suddenly a doctor. If somebody puts on a suit, they are not suddenly a banker. This is a profession that has to do with understanding resilience, fighting fraud, managing payment systems, managing balance systems, creating trust, delivering to clients. This is one thing. But if you stand still, if you don't adapt again, the needs of society and the needs of your clients are changing. So again, the moment we don't move, you see immediately that somebody moves in. For instance, when my son studied in the United States, I didn't even think about using a bank to transfer money because I moved to Wise, because otherwise it would be both expensive and untransparent. So it shows. And the same is, like if you look in Europe at banks like Revolut, or I was in South Korea where you have TOS Bank, which is one app that designs your full financial health and environment. You see that happens. But what I noted in TOS Bank, and again I come back to the role of what we could call traditional banks, they also had a 24/7 call center that was able to cater for every need. And every need. If you needed a complex mortgage at 3 o'clock in the morning, you would get it. And that shows the changes in society. At the same time, they also had a center for at that time they called it that, elderly citizens who want to become more digital. So you see that the human factor is still there. So in my view, there is absolutely a role, and we've seen it here because all of the institutions here are more than 100, if not even more than around 300 years old. There is a role for banking if it adapts to the needs of its clients and the technical standards and the needs of society. And if you don't, then you are extinct, but then you should be.
Charlotte,
yes.
if you go provoked,
I can tell who
by age.
Yeah, who's the 300-year-old in the building? Yes. And I think, well, Richard Nodder started, I think, this competition on age, but in saying that Goldman Sachs is 156 years old and out there because still adding value. And I think that's even for an institution that was founded in 1694, we've had to renew our whole payment system, our real-time gross settlement system, to support the needs of the UK financial system, the UK economy as well. We're having to sort of readapt and think about how we cope with digital assets. So some of it is about actually sort of kind of leading by example, that even traditional banks and let's say you have to kind of keep changing to survive. I think what I have seen over the last at least sort of 30 years that I've been supervising, and supervising mainly banks, but insurers as well over that time, is how even with traditional banks, which I had associated with being more like full service banks, the competition moving to specialization, competing along particular business lines. And so that's sort of in a way how I see it. And will that sort of trend continue? Well, yeah, possibly that specialization, it does bring with it some concentration risk. But it's sort of kind of where can you better compete, and also then compete at scale, and thereby improve resilience as well through that scale.
So Fiona, you were telling that Wells Fargo is 173 years or so.
Sorry, Richard.
Each panel gets more incremental.
Exactly.
So just for tomorrow, if everybody could have the history stats.
So you had to adapt over these years.
I think exactly, and if we think about how we started as a firm, it was the stagecoach transporting the money across the US. But I think the whole point as well is that I do think fundamentally we should have some confidence in all that's happened since the crisis. And I think as much as we're watching innovators, we're watching disruptors, we're also partnering across, whether it's with technology, we're partnering with private credit. I mean, there are partnerships. We have one in particular which is focused on middle market lending. But equally, I think when we see, as Wim said, operators in the market that can deliver simple products much more quickly for us, then I think that's on us to actually take a step back and look at how we ourselves can innovate and adjust. I think when I talk about the confidence, I also talk about the fact that we are now, if somebody new was coming into this space, I would say a lot of the risk and control and reputational issues have been worked on. Not to say there can't be improvements made, but there is a lot of trust in the system. There is, as I said, the bricks and mortars concept, but also the advisory concept. And so for us, adapting, but also not being afraid to be more confident, to partner. But then as well as that, if we are falling behind in certain areas, it's up to us to correct. I think we've all been extremely aware of some of these participants for the last 10 or 15 years, and now I think most banks will see, will have truly, strong digital offerings. And now the great thing as well is, for example, with us, it's English and dealing with the demographic changes in the US, Spanish as well, and all of our digital systems. So I think we're learning a lot, we're adapting, partnership and confidence would be the key areas that I think we have to focus on.
Thank you very much for this. It was great insights. Thank you very much for having shared and amongst us. Now I would open the floor to the audience.
Thank you. Very interested in the focus on operational resilience. When you're looking at financial risk, there are lots of metrics that external stakeholders can consider to see about the relative risk of individual financial institutions. With operational resilience, it's much, much harder. Is there anything either from a regulatory perspective or from a bank CEO perspective in terms of managing your stakeholders that you can point to that says, well, X financial institution is clearly more risky than others, given it's a tail risk when we're thinking about kind of those really big outages? Thank you.
Who wants to take this question, please?
So the one thing that I think that we can say as the industry is if there is an issue with another bank is how quickly we can adapt or look at the situation that was there and do a read across to us. You can see it, for example, with some the examples of some of the banks a couple of years ago. Immediately, it was what's the read across to our portfolios, being more public facing in terms of talking about the nature of our loans, the nature of our liabilities. So there is a huge amount of focus now at any of the conferences, investor conferences around that. But I would agree, it's definitely challenging. So I think it's talking through that, publicizing and talking about our frameworks, I think is a good way to go. I was looking to Pedro to opine on which banks were the riskiest, so I won't go there. But I think our job in the industry is every time we see a crisis, make sure that we are after action review, what's the read across, how can we deal with it? And we do, Britta was here earlier, we have extremely intense investor dialogues and they are putting us through that. And then, we see that coming out through the reports.
It is hard there's a lot of work done to categorizing the different levels of risk. But indeed, it's not only bank specific, but also indeed, as I said earlier, systemic. Because again, certainly a successful cyber vulnerability of cyber attack is something that has a risk to the sector. And that's indeed why you want to categorize the different levels of risk. And a lot of work is done there, but it's quite difficult, as you rightly point out.
In setting, we set a deadline for firms to sort of come into compliance with our expectations around operational resilience, but they weren't necessarily, I suppose, in order to get there, and that was to really just kind of focus and get a bit of momentum, more on the inputs. So we were assessing whether banks had even managed to identify their critical or their important business services, whether they'd mapped them, how they're reporting, what was the involvement of the board, what scenarios had been tested from those, and then the response and lessons learned from those testings. So we were assessing across those. We want to get to a position where you can really kind of assess the sort of outcome. But I think taking this approach, sort of at least, it's getting firms into the right, I think the culture, the kind of mindset to sort of explore just how resilient they are.
Thank you very much. I see a question there, a hand there, please.
Yeah, thank you for taking my question. It's Britta from Autonomous. I think Fiona briefly touched on digital assets, and I know we always discuss geopolitical risk in terms of credit exposure, market exposure, and operational resilience. But operational resilience also impacts deposits, and that is a big discussion point amongst investors. The rise of stable coins and the debate how to treat stable coins versus tokenized deposits. Maybe you can give us a little bit of insight where you rank that sort of risk, whether you run scenarios on it.
So for us, in terms of what we're doing within the EU, we haven't looked at that. I think much more developed in terms of the parent in the US, not surprisingly. And also encourage very much as well to take a look at that and take a look at it particularly across our wealth management and and for our CIB side. So I'm probably not the best person to answer it for you, Britta.
I mean, on the, we've taken view that the deposits are what banks are about, and that's about money creation. So tokenized deposits can be issued by a bank, but not stable coins. Now, banking groups will have, no doubt, stablecoin operations in their groups, but it's in a separate sort of part rather than out of the bank itself.
Very good. I don't see any hands. So this is because we are really at the 5:15. I think
that the lights on and off try to signify something to you.
I think that was a matter also of operational function.
Yeah, it was exactly a stress test.
So if there are no questions, it's just for me to, again, thank you very much for having joined the panel. It was a great discussion. I think you were very candid and very open also in sharing not only expertise but experience. I think that's what we wanted to get out of this panel. And with this, I would just invite everybody for a round of applause for our panelists. Thank you.
Thank you also from me and from all the organizers here. And this was our last panel. So we're coming to the closing of the day. We will see you again tomorrow morning, hopefully, at 9:30, for the keynote speech by Ireland's Finance Minister and Eurogroup President Pascal Donoghue. And for those of you on site, please remember to plan sufficient time for the security screening. But coffee and pastries will be ready at 8:30, so if you decide to come early. And with that, I wish everybody online a good evening and invite for those of you here in the room for a drink if you go up the stairs on the side on the platform. Thank you very much.